If you look at the Fed, they've been talking about patience, the need for more time, the need for more data.
We still think the Fed will begin cutting late this spring or in the summer. But again, it's just not going to be a straight line.
We think that the Fed is probably going to be on hold here at least until June.
What we're looking at going forward is higher for longer rates, less rate cuts than the market expects.
There's quite a bit more data to come before you get to that June FOMC meeting.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
I've been practicing this. Good morning. No, I can't do it. That's his thing. From New York City for audience worldwide. Good morning. Bienvenidos. This is Bloomberg Surveillance alongside Annmarie Hordern and Menace Craney. I'm Lisa Abramowicz. Jonathan Ferro is not here. As you've noticed, I am not him. He is on a well-deserved couple of days off. We're returning with us next week. I have to say, I want to kick off with a market that is Teflon. It seems like nothing seems to bother it. For a hot second, we had some inflation concerns. Then those were a dip that was buyable. Menace, what do you make of the fact that nothing seems to matter in this market?
It is Teflon. It's almost as if the entire equity market has gone to Ibiza in January and just started partying already. I mean, it's just unbelievable. The past 48 hours, we've gone from rock hot CPI, which Paul Donovan said was hashtag hot, and then we got hashtag hysterical. It just doesn't seem to touch the sides, does it? Well,
okay, so yesterday we had a really sizable rebound as people shook off this feeling that maybe we'd get some sort of resurgence in inflation after a CPI data that came in hotter than expected. We heard from Austin Goolsbee. Basically, we're looking at PCE. We're not even looking at CPI. There seems to be a complacency. Are we starting to see cracks, though, Menace, under the hood when you start to look at some of these auto manufacturers and others starting to talk about margin compression, starting to talk about layoffs, starting to talk about a little bit more uncertainty?
Well, I think if you look at some of the reporting numbers that have come through in the past 24 hours, 48 hours, it is about margin, especially for the bigger plane makers, along with the automakers. We'll talk about that in a moment. But go back to what Mohamed El-Erian's op-ed is about. He said, it is a folly to completely ignore the CPI data. It's just almost an infantile, sort of attitude to take towards the data. It has got relevance at some level, and that's Mohamed El-Erian, not me.
Infantile. That's a way that people like to describe. Very well done. I'm wondering, Annmarie, we are hearing from the administration, we are hearing from Janet Yellen, who doesn't think it's infantile to look past CPI, who thinks that probably you should look at the progress. It's going to be bumpy, but this is exactly what you're kind of going to expect.
And they're going to keep going back to the fact that wages have kept up with inflation, although we should note that real wages are actually lower than when Biden took office, so something that could potentially hurt them. Yesterday, she spoke to CBS and she said Americans should feel confident that inflation will come down to levels that will no longer really be noticeable or worrisome to them. The issue, though, right now, though, if you look at the polls, inflation is still bothering consumers. That's why I'm so interested about retail sales today. Does that health of the consumer continue?
Yeah, well, this is what we're going to be watching heading into a retail sales, given the fact that we do get that at 8:30 a.m. as well as initial jobless claims. The expectation is for it to come in again at a pretty low number of 220,000. Coming up this hour, we do have Julian Emanuel of Evercore with U.S. stocks bouncing back from the CPI surprise. Wendy Schiller of Brown University as GOP frontrunner Donald Trump doubles down on his criticism of NATO. And Gilles Moek of AXA Investment Managers as the UK and Japan dip into recession, even though people don't seem to be paying attention to it. We begin with our top story, U.S. stocks looking to gain back losses from this week's hot inflation print. Julian Emanuel of Evercore ISA, not surprised, saying, quote, the reaction to CPI was FOMO turned to fear, typical when data disappoints in a momentum market. The good news is cuts are now appropriately priced given the potential for an economic slowdown in late 2024. Julian Emanuel joins us now. Congratulations. You have the prize of the week saying Goldilocks gets a gut punch, which I absolutely loved yesterday. Why does nothing seem to matter?
This is a truly extraordinary environment because nothing seems to matter on a lot of fronts. And frankly, when you come down to it, this is still an economy, a market that is actually still working off, despite 2 years of record tightening, the extraordinary stimulus. We just don't appreciate, and maybe we're starting to appreciate, how extraordinary the amount of stimulus that was put into the economy in 2020, 2021, and the Fed was actually still buying bonds to start 2022. And that has gone much longer than people would have thought. And frankly, you're now at this point where a lot of the data is counterintuitive to a market that keeps rising. And so you've gotten emotional. And now we're in this chase We haven't had these kind of conversations with clients since 2021.
Okay, I'm getting a little bit emotional. You're talking about how, yes, there are all these extreme yet not irrational valuations, but the headwinds to Goldilocks are there. How difficult is it for you to convince people of this, given the fact that people can look past it and see a lot of gains with respect to earnings, particularly with the leaders in this market?
It's very trying, but again, what you're seeing, especially from day to day, and you see it in the small cap indices is one of these areas, up 2, down 4, up 2, and again this morning, leading lots and lots of cognitive dissonance, and frankly, this is a point in time where people are paying more attention, as they perhaps should, given the last couple of years, to the price action rather than the fundamentals. We think there'll likely be a time where the fundamentals do sort of take a front and center stage that says, okay, let's pause here, let's digest the gains, but we're not there yet.
So if we've got to have a moment of pause, if you look at the 13F filings, I know they are historical and they're from before Christmas, but you see people like Michael Burry, I would say capitulating, or just honestly saying, look, I had a big put option on semiconductors, and you know what, I was wrong. So he's cut his losses. I use the word capitulate, but do you think we're going to see more of that, or do you think that that has run its course, those kind of moves where people throw in the towel on possibly being short of this market and trying to fight against it, and they just go, look, this is a rising wave, I can't afford to be out of this?
Well, so if you look at the past, and the past is not always exact but instructive, you got to 28 times earnings at the top of the bubble in Y2K. Mm-hmm. You're at 22 times now. Our work says that on a 1-year forward basis, your expected historical return is 0. That having been said, you're at a time where, again, we'll probably get a better look on the degree of capitulation next Wednesday, when the stock that is the market right now, and we all know what that is.
Do you want a drum roll?
Exactly.
It's NVIDIA.
Exactly.
NVIDIA we trust.
Reports earnings. And you look at the move in those shares, up 45% year to date. And that company could go 20% either way next week.
You actually think on reporting day they could swing by as much as 20%? But it's going to have a much more pervasive and wider influence, though, apart from just its own movement in of itself, isn't it?
It absolutely has, and it has in the last several quarters. In fact, if you go back to the May quarter, where there was the original, oh my goodness, this company can actually report earnings that we've never seen before, it catalyzed an entire market run-up from May into the July peak.
You've been talking about being defensively positioned, and you're talking about being defensively positioned in stocks. Is it also having a larger than sort of average portfolio of bonds at a time, where people are concerned about inflation, people are concerned about the Fed, but not concerned about a downturn? And
they're not concerned about the inverted yield curve either, Lisa. So when we talk about bonds, we're just as happy to be in cash right now, because again, part of the narrative around bonds that we've seen the last several weeks is yes, Japan's falling into recession. Yes, we learned the UK is falling into recession this morning, but the Atlanta Fed GDP is 3.4%. And in that environment, you'll clip your coupon and you'll probably get some capital appreciation if the economy slows, as we think it does, towards the end of the year. But, at 5%, cash is not too bad either.
Do people throw straws at you when you walk into a room and start telling them, just sell everything, go into cash, and go into defensively positioned stocks?
So here's the rub, is that, first of all, that's never an option, okay? Because let's go back 40 years. You don't time the market in that respect, because when you do, you sell your stocks in March of 2020 and you don't hold on for the next 4 years. So we don't think that way. But there is a way to do it rationally. And when we look, and this is part of what the conundrum of this year is strong U.S. economy. Mm-hmm. What sectors are underperforming the S&P 500 this year? Consumer discretionary, industrials, materials, and energy. Go figure.
Well, does that say to you, I was going to talk about Japan, but you've curveballed that. Those underperformers, what does that say about the silent recession that many people say to me is having? It's not a huge job-cutting recession. We're coming to the end of savings. We're coming to the end of COVID money. With those kind of underperformers, what does that say about the underbelly of the economy?
So that message is not yet clear, but the concept of that message not being clear is the flip side.
Okay.
Is what it says is everyone's buying technology, communication services, which is actually, in our view, has a lot of defensive properties, and we like that sector. And strangely enough, healthcare. It's that kind of environment, but you need to stay invested, but you can also have an eye towards defense as well, the cash hold.
How much can the U.S. continue to grow, though, when you wake up in the morning and Japan's in recession, the U.K.'s in a recession? At some point, will something stop U.S. exceptionalism?
So, in theory, that should be the case, but this is one of these cycles that we all thought coming out of the pandemic, there would be this element of synchronization for several years on end. And obviously, if nothing else, China really interrupted that calculus by staying in COVID zero for too long. And that is part of the story. The thing about the U.S. economy is it's much more insulated and self-contained than the rest of the world, on the order of 70 to 75%. So it's one of those. It can go on until it doesn't. And frankly, the most important economic number is the every Thursday at 8:30 jobless claims number. Okay, that is on the ground, real-time data, the health of the economy. We haven't started to crack yet at all.
So we are 2 hours and about 20 minutes away from the most important indicator of the week, of all indicators that we might potentially get. What is sort of the tradability of this number and retail sales, which is another read on the health of the U.S. consumer?
Well, the clear implication of what we've seen in the last few days is don't trade the numbers, okay? Because if you traded CPI and you didn't have any time to sell or short the market, and if you went and did that after the number, you're already far underwater given the bounce back we had yesterday. This is, again, one of these times where you have to think about your risk reward and know that there's a difference between the institutional investor, whose own risk is probably greater missing the upside, versus the retail investor, who should probably be thinking, as we encourage at times, how do I feel here? Do I feel a little bit greedy? If I do, let's reconsider, let's trim a little bit, and let's make sure that, and thinking about the last 40 years, you make money by buying pullbacks. That is the way. And if you think that you're going to be a seller down 10 or 15%, you should be trimming your holdings now.
Julian, always wonderful to speak with you. Julian, you're sticking with us. We'll ask, are you feeling greedy? Julian Emanuel of Evercore. Right now, let's get you an update on stories elsewhere this morning. Here's a Bloomberg brief with Yahira Hakez.
Hi, Lisa. Celebration turned into chaos in Kansas City. At least one person is dead and more than 20 others wounded in a mass shooting during the Kansas Chiefs Super Bowl victory parade yesterday. Authorities say at least 8 of the victims are children. 3 suspects are in custody. Mayor Quinton Lucas says the White House and federal agencies have offered assistance, while President Biden renewed his call for an assault weapons ban. Morgan Stanley is planning to cut several hundred jobs in its wealth management business. It would affect less than 1% of employees in the group of about 40,000 workers. The cuts will be the first under new CEO Ted Pick, who took the helm in January. Morgan Stanley cut more than 3,000 jobs last year as the bank looked to reduce expenses amid a drought in deal making. For the second time this year, a U.S. company will try to put a spacecraft on the moon. The Nova-C moon lander, built by Houston-based Intuitive Machines, took off this morning on a SpaceX rocket from the Kennedy Space Center. It will attempt to land on the moon in about a week. If successful, it will be the first privately built lander on the lunar surface. And that's your Bloomberg Brief. Lisa?
Yahira, thank you so much. Up next, Ukraine aid facing an uphill battle.
60 billion with a B. They want to give them 60 billion more. And I said, wait a minute, do it this way. Loan them the money. If they can make it, they pay us back.
That's coming up next. You're watching Bloomberg Surveillance. Drumbeat to retail sales and jobless claims. Good morning. This is Bloomberg Surveillance alongside Annmarie Hordern, as well as Manus Crenny this morning. John Ferro, on a well-deserved few days off. He will be returning next week. Right now, we are seeing markets with another lift after an incredible retracement yesterday. Stocks futures going still above 5,000 after clawing back some of the losses made on fears of inflation. What inflation? 5,024 on the S&P, up about 0.1%. Euro gaining versus the dollar, just slightly up 0.1, 107.36, even with some weaker than expected data out of Europe. We'll go into that in just a bit. The 10-year yield down just slightly again. That retracement of 422 right now on the yield at a time when people are expecting the Fed to still cut, even if inflation is a bumpy road lower. And of course, crude a little bit lower as we talk about maybe an oversupply. We'll get more into that later on. Under surveillance this morning, Ukraine aid facing an uphill battle.
60 billion with a B. They want to give them 60 billion more. And I said, wait a minute, do it this way. Loan them the money. If they can make it, they pay us back. If they can't make it, they don't have to pay us back. Loan them the money. Put it as a form of a loan. Why should you just hand it over to them? Do it as a form of a loan.
Here's the latest. NATO defense ministers are meeting today with U.S. efforts to further assist Ukraine deadlocked in Congress. Donald Trump doubling down on his criticism of NATO. Bloomberg reporting that Trump may scale back NATO commitments and push Ukraine to negotiate with Russia if elected. Rendy Schiller, a director of the Taubman Center for American Politics and Policy at Brown University, joins us now. You know, I got to be honest with you. At a certain point, I can't parse out the noise from the signal. How much are you looking at this, Wendy, and saying that there's something behind here other than just bluster?
Well, no, I mean, Trump is trying to remind people that he was president of the United States. He did deal with world leaders. He does have a position or a philosophy, which is that you don't spend U.S. money on conflicts abroad when there's no direct U.S. interest. And he has said repeatedly that Russia's not our enemy and this is not our war. And he is tapping into a strong vein in the American public of avoiding, deep military conflict or deep military assistance to foreign lands. I mean, not just U.S. troops, but clearly U.S. money. And when his base is thinking that they're falling behind and they're not getting things from the U.S. government domestically, it's a powerful argument to say we shouldn't be sending $60 billion in aid abroad.
I mean, the whole idea of this aid, though, that it's money, it's actually weapons. It's U.S. money putting back into the U.S. industrial complex, and then old weapons will go to Ukraine. But when he talks about a loan for Ukraine, how much is that putting pressure on Republicans in Congress to just continue this paralysis when it comes to the foreign aid bill?
Well, I think he's putting tremendous pressure. You've seen yet another Republican member of the House, who's chair of the oversight, the Homeland Security Committee, say he will not run for re-election in a pretty safe seat. You're having almost a record number of members of the House, Democrat and Republican, walking away from the House of Representatives. And the Republicans who are walking away don't want to face a Trump onslaught. They don't want to have to do Trump's bidding, not only now, but if he wins for the next 2 to 4 years. So you're seeing a reverse Trump effect on the actual infrastructure of the Republican Party in the House. And you're right. The Biden administration has done bad messaging on Ukraine in the sense of explaining what those dollars actually buy and that they support the U.S. economy through the defense industry.
We woke up this morning to new comments from Vladimir Putin talking about President Biden. He says to Russia State TV, quote, he's a more experienced person. He's predictable. He's an old style politician. What do you make of this? Who do these comments actually help when it comes to the race in November?
Well, I mean, it's an interesting sort of muted, attack, if you will, on Biden. And obviously the Trump-Putin connection, Trump has said favorable things about Putin, and it has not hurt him among his base. I think the Russians technically want to stay out of 2024. I think they'd prefer to see Trump come in. And I think they're testing the messaging in the American public of making Russia the enemy. Is it still working for Biden? Is it still working for the Democrats? And that's what they're doing by sending out cased in reasonable language, but certainly trying to dig at Biden and seeing if that plays in the American voting public.
Well, it's only a backhanded kind of slap, isn't it? He's a more experienced, he's predictable, he's an old-style politician. So let's see where that discussion goes. I want to get your take on this bifurcation proposition that Trump puts on the table about NATO. How concerned? We heard from Stoltenberg talking very clearly, attack on one is an attack on all. But for the NATO allies, this is a very clear indication, the road of travel, that if Trump arrives in the White House, the real risk is that the US pulls out of NATO, or is that just extrapolating too far?
I don't think President Trump will pull directly out of NATO if he's president in 2025. But there is a pattern. He pulled out of the Iran deal, which is, multilateral. He pulled out of the Paris Accords on environment, multilateral. He is not a multilateralist. And he will not support sending lots of money to support the North Atlantic Treaty Organization, which is something created out of World War II, because its poise or its mission was really to thwart Russia. So I think there is something there, but I don't think that he would feel supported in pulling us completely out of it or not coming to their aid when he looks at the polls. And he doesn't technically have the right to run for re-election again. So that's another thing to think about Trump. What does he want to do in 4 years? Because this will be it for him, the 4 years in office, if he believes that. So these are the kinds of things the Europeans and NATO allies have to calculate. But I think he likes generals. He typically listens to generals. So I think that there will be a huge push against complete withdrawal from NATO.
As a political historian, Wendy, does it frustrate you that with all of the calls on the Democratic side for Joe Biden to consider somebody who is younger and newer and fresher to the political scene, that there has been no movement on that front?
Well, as I've said before on this show, I do think that Joe Biden will run if he's healthy enough to run in his own mind. He has time, actually, and he is the leader of the free world. He is the leader of what is now the most vibrant economy, or close to the most vibrant economy on the planet. And he doesn't think that anybody else in the wings can beat Donald Trump. Now, at the convention, which is a long time from now, if there's a real push, they can nominate somebody else. Party conventions used to actually select our presidential nominee. So there is a way for the Democrats to do this if he's really tanking in the summer. Clearly, his allies in the White House, obviously his staff people, and he himself does not believe that he will be tanking come summer. He's waiting for Donald Trump to trip himself up in more public appearances. That's been the pattern in the last 6 weeks. And, ask us in April or June. I think that would be the Biden response in terms of how they match up with Donald Trump.
We'll ask you in April or June, hopefully before then. Wendy Schiller of Brown University, thank you so much for being with us. Still with us, I'm so glad to say, is Julian Emanuel of Evercore. And I have to say, Julian, all of these people who come on say the market's not going to go down in an election year. The Fed's not going to hike rates in an election year, including you, despite some of the concerns or talk recently that maybe they need to combat inflation. How do you factor in the silly season of elections into some sort of thesis?
Well, let's decompose that. The Fed is not going to hike rates in an election year. And that's part of why the market rebounded yesterday. Because when that CPI number came out, we had a number of people say the reflex reaction is, the next move's a hike. No way. Not happening in front of the election. And Goolsbee actually came out on camera to more or less remind people that's the case yesterday. Look, this is an incredibly complex environment. I don't think I need to tell that to anyone. It is no great surprise. But when you think about politics, the temptation would be to say, it's an election year. Yeah, they're stimulating, and that is good for the market. And that has proven to be the case so far. But our work says that this is an extraordinary election year. The control of Congress, as we've seen by the incredible focus on an election out on Long Island that, normally no one would really care about. But when the House has 10 or fewer seats in the balance of power and the Senate 2 or fewer, that means volatility this year. And that's what we're going to get.
All right. That's what people keep saying. Buckle up. And we're sitting here waiting. And the buckle seems to only matter because it just keeps going up. Julian Emanuel of Evercore, thank you so much. It is always wonderful to have you, a wonderful friend of the show. Coming up, Airbus shares falling after the company announced disappointing guidance amid supply chain issues. It's evidently not just Boeing. 2 hours until the most important data of the week. As always, we get initial jobless claims. We also get retail sales, a look at the U.S. consumer that has powered a rally that has defied almost all expectations. Let's take a look at that rally, getting a little bit more added to it, up 0.1% in the U.S. S&P futures, 50.24 after crossing that 5,000 line again yesterday. Basically, CPI hotter than expected. Did we really care about that? NASDAQ futures up about the same amount. Russell 2000, and this is one I've been watching, Menace, the idea that it sold off dramatically in the wake of the expectation that maybe the Fed would have to hold rates higher for longer. And then yesterday, retracing with a bang. How much is this sort of the trade that is the way to play rate expectations and interest rate fears, and frankly, the first place people go when it's risk on?
Yeah, I mean, if you think Goolsbee came out and really his comments yesterday, I think, took some heat out of the CPI. He was wheeled out yesterday to say, look, stop getting hysterical over this CPI print. Focus on what you've been known to focus on, and we focus on, which is the PCE. And we don't have to make it all the way to 2%, basically, to begin the cutting cycle. And I think one of the interesting conversations I've had this morning on Bloomberg Brief, which was the slowdown in Japan, the slowdown in the UK, and the slowdown in Europe is more malevolent from an interest rate perspective, not an equity market perspective. I know the two of you would cry at me and go, heresy, that the world, US equities can survive without anything from the rest of the world. I get it. But from a rates perspective, the ECB and Japan are going to be in a different trajectory now because their economies are so under pressure.
Which is the reason why perhaps people are piling in. We'll get there in just a second. In the U.S., the rate fears basically tempered after you got some of the comments from Austin Goolsbee, who, as you just heard Menace say, was wheeled out. I'm not sure that it was particularly orchestrated. We're seeing a bit lower, no drama, two-year yields for 22%. The two-year yield down from as high as 460, 456, as people really try to figure out whether the Fed will still cut rates. It seems as if they're still on that path. And then if you take a look at that differential that Menace was just talking about, this idea of weakness over in Europe, over in Japan, and if you bring that through the currency exchange, what's interesting here is this idea that not as many rate cuts could actually bolster the euro region. We did hear from Christine Lagarde coming out and saying it's premature to cut, still trying to sound hawkish as they try to get inflation under control. Under surveillance this morning, let's get to one of the topics that just doesn't seem to go away. Israel will not send delegates to Cairo for talks aimed at securing a pause in fighting with Hamas. Prime Minister Benjamin Netanyahu is calling demands from the militant group delusional. Hamas is demanding a total withdrawal of Israeli troops in Gaza in return for the release of hostages. Meanwhile, Israeli forces are preparing an assault on the southern Gaza city of Rafah, where it says Hamas firefighters do remain. Annmarie, I have to say, I don't really understand the back and forth behind these stories. I don't understand where the U.S. influence is. I don't understand, does this mean that we're not going to get some sort of ceasefire, or that we're making progress and this is part of the whole negotiation? Two things I think we need to remember this morning. According to Israeli press, there was a lot of pressure on Netanyahu to send a delegation for those talks earlier in the week in Cairo with the head of Mossad and Director Burns of the CIA. So to say that Israel's not going to go to the second one, I'm not surprised if they were really reluctant to go to the first meeting. Second, we have to remember the New York Times just the last hour is reporting that Israeli troops have actually entered a medical complex in Gaza already, in southern Gaza. So what the Israeli military is saying in their statement is that they are conducting a precise and limited operation inside Nasser, this medical complex in southern Gaza. But this is going to draw a lot more condemnation from a lot of individuals around the world who are saying enough is enough, given the death toll of Palestinians. Do we have a sense of whether President Biden's policy toward Israel is shifting at all, or if there's just sort of a shift in rhetoric recently? Well, you've seen a lot of those reports about what he's calling Benjamin Netanyahu behind the scenes. This administration is definitely frustrated. You've also seen a lot of Democrats in Congress say that they don't want to send more aid to Israel without strings attached. Now, that aid bill, obviously, we know is still shuffling around. We potentially not sure when that's going to actually see the light of day for a signature from the president. But the fact of the matter is, you do see Democrats starting to definitely take a shift. And there's a tremendous amount of pressure on Biden to really try to get Israel to what he said. Well, he said it was over the top. So
he's actually called for a credible plan. He had the meeting with the King of Jordan just the other day, and that was the first face-to-face meeting of the King of Jordan with Joe Biden, where Joe Biden said that we need a credible plan for more than 1 million people sheltering. And the King of Jordan goes on to talk about the catastrophe, the certain to produce a humanitarian catastrophe if this scales up the way that it's presumed to do. Well, on a lighter topic, to not to shift gears,
But hedge funds are helping to fuel the rally in big tech and AI. It's a hard pivot, didn't really make it well. According to the quarterly 13F reports with the SEC, Amazon, Intel, and NVIDIA were among the top targets from investors. The rush helping NVIDIA rocket to the third largest U.S. company by market cap. Just this week, the chipmaker has surpassed both Amazon and Alphabet. It's now its own country, the country of NVIDIA. I have to say, you know, when I look at 13F filings, Manus, do I care about them? They're looking at a moment in time at the end of a quarter that happened a year ago. Not really, but it feels like it. And it doesn't really take into effect short positions. Does it tell us at least that they're playing in the big guys like everybody else?
Look, I always think we like to look through the window. It's a bit like that sweeping shot that you have coming in here. It's coming in through the window and looking, look, what is Michael Burry doing? He's capitulating in theory. It gives you an insight into emotion. And I think Julian Emmanuel just summed it up beautifully. He said next week he thought NVIDIA could move, the stock that he can't name, could move by 10, 15, 20% on their reporting day. And that, Lisa, is the more prescient move. But it is fascinating when you see that still, I mean, you'd have to be living under a rock not to realize that tech was sort of widely scooped up in the run up to Christmas.
So it's good for storytelling, which it is.
Yes.
It's just a question.
It makes Bloomberg Surveillance fill 1.5 minutes on 13F filings. Go on.
All right, let's talk about storytelling. More Fed speak, a different kind of storytelling on deck with Waller and Bostic set to speak today. Comments from Presidents Barkin, Daly, and Vice Chair for Supervision Michael Barr. Rounding out the week, investors looking to retail sales and jobless claims about 2 hours from now. It is very important. We also get U.S. PPI and the University of Michigan Consumer Sentiment Survey due tomorrow. To me, this is the conundrum. You either have good economic data that then leads to inflationary pressures, or you start to get a slowdown that creates some sort of pressure on both the political sphere, but also potentially that's enough to bring down inflation. Did we hear any acknowledgement yesterday, Annmarie, from Janet Yellen, about this difficult moment and how it's been difficult to message and it's been difficult to forecast?
Well, the administration will continuously say there's still more to do, especially when it comes to inflation. So they're going to want to tout some of their victories. Look where we started. Look where we are now. But there's still more to do. And they understand that this is hitting, especially when you look at the recent inflation report. These are food prices going up, some energy bills when it comes to electricity going up, insurance going up, daycare going up. They understand that it's hard for the everyday American consumer. But they will point to you with the Michigan survey coming out. They're going to say people actually are starting to feel better about the economy. But will that remain the same if inflation continues and if it stays hot?
Yeah, well, this is going to be a key question, especially given some of the stimulus that evidently keeps people's bank accounts full. Meanwhile, it is not just Boeing. Airbus striking a cautious tone. The plane maker saying they expect to deliver a lower than expected 800 planes this year due to, you got it, supply chain issues that are continuing. CEO Gayami Fari speaking on Bloomberg Brief earlier today with the one and only Manus Cranny.
We've guided for 2024 for around 800 deliveries, coming from a guidance last year that was 720. We're on track with a ramp-up to reach the rate 75 planes per month in 2026. So that's basically what matters for us. And I consider we are roughly in the ballpark of what was expected or what was to be expected in terms of ramp-up. So I consider we're on track with our ramp-up plans.
For more, George Ferguson of Bloomberg Intelligence joins us now. So it's not just Boeing. Are Airbus's issues on par with the same that we've just been lambasting over in their American counterpart?
Well, I mean, they're not, right, because they're not having the quality issues. And I think that's probably pretty important for Airbus here, right? The ramp up actually was a little better than we expected, that I'm sure there were some more exuberant people on the street that thought they could go even higher. But I think they're really trying to control quality here, make sure their manufacturing facilities are performing correctly. And so they're, probably going to hold back the increases a little bit. And it's going to cap their ability to take market share from Boeing. Maybe the market's a little disappointed about that, but it's a very intertwined supply chain in this industry. And so if one company's having problems with it, it's a good bet usually that the other manufacturers too.
George, good morning. How important or how credible is the argument that now is the moment when Faure can really make hay at Boeing's expense? He wouldn't answer. United are in the process, we understand, of renegotiating with Boeing. I mean, this is a classic moment of where you go on an aggressive marketing campaign, sales campaign to win additional market share? A, do they have the capacity to deliver on those and any new wins that they get? And B, will they get a tailwind, from the debacle on the other side?
I mean, I think United's a very good case in point, right there. You want to win those good core customers. You want to keep them for a long period of time. You want airlines to go to buy a lot of airplanes. And that just makes it really harder to get wins here, right? Because you got to go find a lot of capacity for airplanes. And those airlines want it in the near term, not in the long term, right? So that narrow body backlog right now is 7+ years long. If they tell United they want to conquest them, bring them over to the A321, they can't tell them they can get them airplanes in 5 years. And you can't move the supply chain that quickly in this business. You can't, it's already stressed. You can't work it that hard to get, 100, 150 airplanes for United in the next 2, 3, 4 years. It's really hard in this business, I think, especially where we are now with backlogs, to go out and conquest a lot just because Boeing's having a problem. That's one of the saving graces for Boeing right now.
Do the Boeing and the Airbus CEO have a responsibility? And again, I tried to push them on this. Do they have a responsibility? They were aggressive negotiators with their supply chain, and that was in the pursuit of profit and margin. That is ultimately the objective, to deliver equity shareholder return, which is about delivering margins. And in a certain extent, the CEOs of these airline companies have got to take responsibility for the negotiation practices with the supply chain. Will it change?
I think it has to, right? I think what you're seeing is Boeing already changed part of it when they went to Spirit AeroSystems, adjusted some of the reimbursement for the aircraft, especially 737 and 787. And we saw better results out of Spirit, this quarter. I understand right now that Airbus is in the middle of those negotiations as well. At Spirit, I would expect that could help Spirit's results. At Raytheon RTX, the Pratt & Whitney issue, I think the engine makers have more power. So I think that's less on the manufacturers and their negotiation for better margins, and more on RTX management and their and what they've done to accomplish the plan.
George Ferguson of Bloomberg Intelligence, thank you so much for catching up with us. Let's catch up with other stories in the world this morning. Let's get over to the Bloomberg Brief with Yahira Hakis. Yahira.
Hi, Lisa. Bitcoin is once again leading the crypto market higher, climbing past 52,000. The move is part of a broader rally that also sent Ether back above where it was before the Terra USD stablecoin collapse 2 years ago. Bitcoin has surged 22% year to date, pushing its market cap above $1 trillion for the first time since December 2021. Cryptocurrencies have been gaining momentum thanks to the debut of Bitcoin ETFs. Cisco shares are falling in the pre-market after the largest maker of networking equipment slashed its full-year forecast. It also said it would cut about 5% of its global workforce. That's about 4,000 jobs. The restructuring will cost about $500 million. Cisco is grappling with a slowdown in corporate tech spending as companies worry about the state of the economy. NVIDIA's scorching rally continues, with the chip maker surpassing Alphabet's market value. It comes just one day after the company overtook Amazon's market cap. The chip giant is up 49% this year, with the company now worth $1.83 trillion, making it the world's fourth most valuable after Microsoft, Apple, and Saudi Aramco. That's your Bloomberg Brief. Lisa?
Yahira, thank you so much. Up next, the UK is sliding into recession.
I think the big change is that we've moved from how restrictive do we have to make policy to get back to target sustainably, to for how long do we have to maintain this stance of policy to achieve that.
That's next. You're watching Bloomberg Surveillance. Building on gains, welcome back. This is Bloomberg Surveillance. Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern. John is off today. Annmarie Hordern is in, and so is Manus Cranny, which we're so pleased to say, coming from the Bloomberg Brief, dropping by our set as markets continue to climb. Why not buy if you can? That seems to be where people are at. S&P futures up about 0.1%, just sort of continuing rising above that 5,000 mark. Euro gaining just a touch versus the dollar, a question of policy response after weaker than expected in the data from that area, 107.37. 10-year yields off just about 3 basis points, but really markedly higher after that CPI print that came in hotter than expected and crude lower. And this, to me, is a really interesting story. Annmarie, I'm wondering what you think. The idea that supplies are outweighing some of the demand. We heard that today from a couple of different groups, including OPEC.
Well, what's interesting what's going on is the fact that you still have oil under pressure when there's hostilities in the Middle East. The fact that the Houthis still remain to be able to hit vessels going through the Red Sea, and you have supply having to take this very long, cumbersome journey around Africa, yet oil is still holding up. Like it's lower. How much lower would it actually be? I continue to remain if we saw no hostilities. And a lot of this, though, of course, has to come down to China. Well, until demand gets back in China, this is where levels are going to be.
And it highlights how the demand in the U.S. has been so different from elsewhere. And we've been talking about that all morning. This idea that the U.S. kind of stands alone when it comes to some of the exuberance. And we see the U.K. falling into recession. We see Japan falling into recession. Man, markets don't care.
Our markets here don't care, and even abroad, they're sort of fairly phlegmatic in that regards. The rates market has responded in the UK. We've gone to like nearly 80 basis points of a cut in the UK from 60 bips yesterday. So there has been a reaction function in that. They're going to have to go, well, maybe they will have to go a little bit earlier and a little bit more size than we presumed just a week ago. Inflation as well this week in the UK came in a little bit better behaved. So, you know, there's a couple of different facets going on in the UK, and then the European economy. And this is where the rates narrative might shift. We may have a shift. We've been talking myopically about the US, UK and Europe. Now we will talk perhaps about a more concerted monetary policy reaction function, perhaps a little bit earlier and more in size than we anticipated.
Well, I think we should talk about that. Under surveillance this morning, the UK sliding into recession.
I think the big change is that we've moved from how restrictive do we have to make policy to get back to target sustainably to for how long do we have to maintain this stance of policy to achieve that, and that's an important. Services inflation is still above 6%, so that is not compatible with a 2% sustained inflation target. It's got further to go.
Here's the latest. UK GDP falling 0.3% in the fourth quarter of last year, sliding into a technical recession, and showing the BOE's campaign to bring down inflation is taking its toll. According to data this morning, Japan is also the latest country to slip into recession. The economy now falling behind Germany to become the fourth largest in the world. Joining us now to break it all down, let us know what we're missing, Gilles Moek, chief economist at AXA. It looks like a recession. It sounds like a recession. Markets aren't treating it like a recession. Do you have an explanation?
Because it really doesn't feel like a recession, on the ground at least. Because here we're talking about the European definition of recession, 2 quarters in a row of contraction in GDP, which is what we had in both the UK and Japan. But my guess is that if we were to use the NBR's more holistic definition of what's a recession, I'm not sure the UK would qualify. I'm not sure that Japan would qualify, because one key ingredient which is missing is the reaction of the labour market. And what we've seen is actually the opposite. In the UK, the unemployment rate remains extraordinarily low, even by historical standards. And what makes the Bank of England's job very complicated is that we've had concerning news about the resilience of wage growth. So it's a very strange situation where, yes, indeed, activity is stagnating or slightly contracting, but there is no impact whatsoever on the way the labour market has been operating. So I think that if you ask people on the street in the UK, they would probably complain about the level of interest rates. They could complain about the difficulty to buy houses and so forth. Would they treat this as a proper recession? Well, as long as the probability of losing one's job remains limited, they probably don't see it as a recession.
What would the prospect of, good morning, Gilles, we're pricing at 80 basis points of cuts before the end of the year. That's up from 60 basis points. So we've had a little bit of a jolt in the rates market. To what extent would 75 basis points of rate cuts in the United Kingdom dramatically change or significantly change the growth trajectory? If Japan is in recession, Europe is in recession, the US, goodness knows, might even slow down you. What impact would those rate cuts have, if at all?
No, you're right in the sense that we're talking about a fairly, muted response from monetary policy at this stage. So with 75 or 80 bips worth of cuts, you would move from very restrictive to restrictive stance, which would not necessarily change the overall picture. I still think that there's one signal, at least, that the Bank of England could give by cutting rates even moderately, which is on the housing market. It's a key focus in the UK, always has been. And in the UK, you have a higher than a very quick transmission of changes in the bank's interest rates to what people actually pay at the end of the month on their mortgage. It has been muted a bit in the last few years, but still there is quite a quick transmission mechanism relative to what you would find in other European countries and certainly what you would find in the US. So even at the psychological level, if you want, creating some relief by cutting rates would be not a small thing.
How concerned should we be that we're already in a deep policy error in Europe? We have Mr. Nagel yesterday giving Germany 4 out of 10 for its health status. And I have a great reference. I always say it's a bit like a pug, one breath away from a heart attack. But how desperate is Germany? How desperate is the position for Germany? 4 out of 10, sir, is not a good scorecard for school.
No, I agree. I think I'm on the record saying that the September rate hike by the ECB was probably not necessary. That they had brought the stance at a sufficiently restrictive level to bring about a proper disinflation. And I think we have to be cognizant of the sort of cultural shift that has taken place at the ECB since the departure of Mario Draghi, and not just talking about his own replacement, but the entire change of power balance within the board, within the governing council. So yes, I don't think the September hike was absolutely necessary. Yes, it's very possible that the ECB is going to be a bit late in reacting and cutting rates. However, when it comes to Germany, I really don't think that it is the monetary stance which is the main issue there. Germany is not in its current position, which is a state of shallow recession, because interest rates are too high. They are in this situation because structurally they've made decisions which are coming back to bite them right now. So yes, rate cuts would probably help on the margin, but I don't think it would materially move the dial in the German case. That recession is the product of global conditions, but it's also the product of structural shifts which have been happening in this country for the last 10 to 15 years.
Gilles, just quickly here, we just have about a minute left. I'm wondering if you see the neutral rate, the rate of inflation, the rate of growth being materially lower going forward in Europe after this period is over than in the US, and that rates will reflect that.
I would sympathize with that. One of the big differences between the US and Europe is about productivity. We have this boom in productivity in the US, which is becoming persistent, maybe structural. We don't see it in Europe. And one of the key ingredients to think about the equilibrium interest rate, R star, is potential growth, productivity gains. And the difference between the two sides of the Atlantic is massive. So yes, I do agree there's a good case actually for sort of persistent gap between the two on policy rates. But don't forget, the dominant bond market in the world, it's the US. If there's a downward resistance on long-term rates in the US, it has some contagion effect for Europe as well.
Gilles Moek of AXA, thank you so much. Really interesting to hear about just the structural differences and how that's going to play going forward. Coming up next, Seema Shah of Principal Asset Management, as well as Carlos Tavares of Stellantis and Ira Robbins of Valley National Bank, breaking down some of the hottest topics of the moment, whether it has to do with the vehicle transition, as well as, of course, competition with China, and, of course, commercial real estate on some of the smaller banks and some of the issues there. Right now, no issues in equities, which are clawing back losses after a hotter-than-expected CPI print, marking gains, particularly with the Russell 2000. Yields just a touch lower, heading into retail sales and jobless claims with an ever-seeming strong U.S. economy. This is Bloomberg Surveillance.
If you look at the Fed, they've been talking about patience, the need for more time, the need for more data.
We still think the Fed will begin cutting late this spring or in the summer. But again, it's just not going to be a straight line.
We think that the Fed is probably going to be on hold here at least until June.
What we're looking at going forward is higher for longer rates, less rate cuts than the market expects.
There's quite a bit more data to come before you get to that June FOMC meeting.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
90 minutes until that key report on just how much American consumers like to spend. Good morning. This is Bloomberg Surveillance from New York City for our audience worldwide. Good morning. Jonathan Ferro is off today. I am alongside Annmarie Hordern and Manus Cranny, which is a wonderful thing. John will be back next week. I'm Lisa Abramowicz. And I got to say, Manus, I can't get over the resilience of a market that is immune to the potential for some other downside surprise, whether it's economic or whether it's with resurgence in inflation.
I think our guest this morning, Julian Emmanuel, really encapsulated the narrative, which is there was an English politician in the 1800s. His name was Disraeli, and it was foreign policy. And it's about splendid isolation. And that concept of splendid isolation is very, very real when it comes to the American equity market. In other words, no matter what happens outside the borders, there's still the resilience of the consumer, there's still the strength within the American equity market, and that leaves you with this splendid isolation. How long does that endure?
Splendid isolation of an economy that's very strong, but also splendid isolation of equities that continue to rise for good reason. That you've got the returns, you've got the sales gains, you've got the upside surprises.
Closed economy.
It's but it's also share buybacks and it's also dividends. And when you have cash, you distribute it. And we have seen that again and again. And you have to wonder, is this just irrational exuberance or is this a wall of cash that's being distributed to shareholders because there might not be as many opportunities to buy in a world where a lot of these transactions are not getting through?
Well, is that part of the... I mean, it's not just buybacks here. Buybacks are a huge component of this whole earnings season globally. We've seen it in Stellantis. We've seen it in a number of other companies that we've talked about through the morning time. And so it is about rewarding shareholders for their tolerance. And the question is, can the margins hold up to continue to deliver on the buybacks and the dividend increases?
Which raises this question of some of the cost efficiencies that we keep hearing about. We do keep hearing about layoffs being announced at firms that otherwise are performing well. And it's just
Cisco,
a matter of...
5,000
exactly.
Thousands of jobs, 5% of the workforce. Was it last night? Yes, it was yesterday afternoon.
So what is this turn? How do you make sense of this? Is this a good world, Annmarie, or is this a difficult economy? And this is the reason why it's been such a difficult message to communicate at a time where the markets are flying. Economy is a little different.
It's almost difficult to understand as well when Stellantis comes out and says they're going to have buybacks, $3 billion euros worth of these repurchasing. Yet at the same time, last fall, Stellantis and all the other auto majors said they could not afford union demands. So when you have moments like this, when a massive company is coming out after they have this huge fight with labor unions, I feel like the White House is going to wake up and look at that report and say, oh, now you have the cash on hand.
We actually are speaking with Stellantis CEO coming up. And I really do want to hear specifically how some of these labor negotiations affected their decisions to cut in certain places. Because if labor is more expensive in certain places, then in order to preserve your margins, you have to cut elsewhere. How much, from the people who you speak to, the economists, the people in the administration, Annmarie, is there sort of an acceptance that there's sort of a trade-off right now with auto manufacturers that are seeing real pressure and a difficulty keeping their margins while also paying and meeting some of the demands made by labor?
Well, this administration is going to want to be on the side of labor. That's one of their biggest...
Well, he went to the picket lines, didn't he?
He went to the picket lines. It's one of their biggest compelling pitches as well when you look at a swing state like Michigan. Their biggest issue, though, is going to be, of course, I think today, retail sales. How much is the growth of the U.S. economy on the back of the American consumer? Treasury Secretary Janet Yellen said yesterday inflation, tad bit higher, she had to say, but she said overall it is coming down. But at what point does that higher inflation actually start to impact sales and consumers?
Well, so far, there's a little bit of pushback, particularly on the lower priced items, but maybe not as much on the Hermes and Chanel scarves. Coming up, we're going to be speaking with Seema Shah of Principal Asset Management, talking about that equity rally that, as we were talking about, keeps resuming. Like we mentioned before, Carlos Tavares, Stellantis CEO, will be joining us on the company's warning of a turbulent 2024. And don't miss this. Ira Robbins, Valley National Bank CEO, talking on the commercial real estate risks in the regional bank industry and what he's seeing on his own balance sheet. We begin with our top story, the S&P 500 back over 5,000 as stocks regain some of their losses following this week's hotter than expected inflation print. Seema Shah of Principal Asset Management saying this: equities will likely see volatility in the first half, followed by a rally in the second half as policy easing arrives. Seema Shah joins us now from an actually sunny London. I am curious, Seema, what we're seeing right now, does that count as volatility?
Well, it was volatility for a day. I think that one of the things with the CPI print is, of course, it was an upside surprise. But what happened yesterday is that there is enough ambiguity about that backdrop to enable a lot of that momentum to continue pushing equities higher. So I think the thing is that we know that there could be an element of seasonality. That's potential. We know that there's, of course, as we heard from Austin Goolsbee yesterday, that there's the consideration of what is the implication for the PCE being the most important indicator for the Fed. And then, of course, there's a part which is, I think companies, corporates are really taking a lot of notice of, which is that if you have a stronger inflation print like we had on Tuesday, a lot of it is related to evidence that you have a strong economy. So there isn't that much concern, I think, building at this stage. And it's also, look, it's very, very early days. We don't want to make any major decisions based on one inflation print. But we do know that, of course, we need to be watching very carefully on those price pressures because, of course, as you were just talking about, there could be some fairly significant implications for margins later this year if you don't see CPI continue to fade.
So what do you do with this, with something that could be volatile, that should be volatile, but that just isn't, when you talk about a rate cutting cycle that should boost stock valuations later on, but shouldn't be now? How do you arrange your equity portfolio at a time where everyone seems to be in the same boat and buying ahead of the dip?
Right. So I think you have to take a longer term perspective. I think trying to trade these numbers is just so tough. And what we're doing is we're taking a 6 to 12 month perspective and we're saying, right, we are expecting a slightly slower economy. We think that that will open the door to rate cuts, probably not as much as maybe the market had been hoping. And historically, if you have that soft landing coupled with Fed cuts, that is typically quite positive for equities. So the way that we're seeing it is we're trying to edge into some of the more cyclical trades that we would expect to do well in the second half of the year. So things like small cap, which of course have had more of a volatile period, those are some opportunities that we're trying to take advantage of now.
Seema, good morning to you. In terms of global allocation, I use the phrase, I think I learned it back when I was at school, splendid isolation. But when it comes to equity allocation, is it still America first for the proportion of allocation? You've got Europe in recession, UK in recession, Japan in recession. I'll come back to Japan in a moment. But the weighting must still be to the uniqueness of the US.
Absolutely. So we have maintained that US overweight, whereas Europe stays at an underweight. We have a number of concerns about Europe for this year. And it's not just on the basic economic side. Mm-hmm. We do think that investors are maybe potentially quite concerned about how Europe is going to be almost a fallout from US election discussion narrative that's going on there. And for Japan, it has been a slightly more, I think there's been a bigger conversation about the Japanese trade. So we have had an overweight to Japanese equities through most of last year. But we have had some concerns starting to grow. One of them being that, of course, the economy looks like it's slowing down. The other concern had been, although I think this is fading now a little bit, is that once the Bank of Japan starts to move to a tighter policy, then what would the implication for yen and therefore corporate earnings? But I think given valuations now for Japan are actually flagging as quite expensive, you could see a number of people starting to close out that trade and looking for something else. And at this point in time, it's still all about US equities.
Do you sense any semblance of exhaustion? You talk about Japan maybe having run its last mile at we're at the highest level since 1989. You're looking at dollar yen above 150. You look at these equity markets above 5,000. I had a guest this morning on Bloomberg Brief talking about 5,500 as a conservative estimate. From the sentiment and from the people that you talk to and the flow, is there any sense of overly long, overly exhausted, and perhaps it is time to trim?
We are starting to hear those conversations. So a number of clients becoming a little bit more cautious, posing a little bit more deeper, kind of poking more questions about the Japan trade. with that idea that, look, it's been pretty good. It's worked out very well. It was one of the favored ones last year. But can we honestly expect it to continue with the various dynamics that could play through for this year? And particularly when you look across the global economy and you think, well, where is the real economic strength for this year? Where are the geopolitical tensions and which parts of the global market are going to be most impacted? It really does feel like the US continues to come up trumps on this. So there is, I think, a waning interest in a number of the international markets that there were before.
So is there interest in the markets that haven't gotten as loved? I'm thinking of Michael Burry's big bet on Chinese tech companies. Are you following in?
We're not. We continue to be very cautious about China. Look, with China, it has the potential to surprise. We know that policymakers in the past have suddenly introduced very significant policy schemes and policy mechanisms. But at this point in time, going from their narrative about avoiding over leverage, trying to redirect their economy, concerned about the debt level, we think it's quite unlikely right now that they're going to do anything that would significantly improve investor sentiment towards China. So that's an area that I think we're more concerned about. There are areas of the market within emerging markets, for example, Latin America, where actually you're seeing the fundamentals, valuations, and technicals start to collide in a very, very positive way. So there are opportunities, but it still always kind of leads back to the US.
All roads lead back to the US. We're about to talk to the CEO of Stellantis about a myriad of different things. We've seen some of the Europeans hand back money, the oil majors. I mean, the buybacks here in the United States of America have been phenomenal in that oil sector, in the European sector as well. So buybacks are definitely a hallmark of this reporting season. How sustainable are those, Seema? How much attention do you pay to that?
I think you have to pay attention to it. I mean, buybacks have sometimes in previous cycles where maybe the fundamentals are looking a little bit more concerning, buybacks can just continue to drive the market higher. So we're watching that. I think, though, for this year, and it's slightly related, is it just does come back to those margins. We have been expecting some kind of margin pressure through the remainder of 2024. And one of the areas of the CPI print that you have to, I think, relate back to that margin pressure is, how many times can companies continue to raise prices? Typically, I think companies can raise it once, they can raise it twice. But on a third time, consumers start to lose interest and they turn away. And at that point, companies really start to face margin problems. Do they start to cut labor? Or as an investor, do you start to really think, okay, which company do we know is going to be able to maintain some of that margin pressure, even as other companies are struggling to raise prices?
Which reminds me of Hermes silk scarves. Seema Shah of Principal Asset Management. Thank you so much. Well, it's true. I mean, they've raised prices by about 9%.
Do you know what makes me laugh is you're thinking about Hermes silk scarves and I'm thinking, yeah, it was actually Heineken the other day that said, volumes will be down next year because we can't seem to sustain these price rises. Consumers are now beginning to vote with their euro, their pound, their dollar, whatever, not just Hermes.
Well, but no, they think that the distinction is actually really important. Heineken versus Hermes. It's a very different cohort of where you can get the pricing power.
Can I just say the Hermes ties don't hold the microphones very well.
We're crying for you. Let's get an update on stories around the world. Here's your brief with Yahaira Chakas. Yahaira.
Hi, Lisa. A celebration ended in chaos in Kansas City. At least one person is dead and more than 20 others wounded in a mass shooting during the Kansas City Chiefs Super Bowl victory parade. Authorities say at least 8 of the victims are children. 3 suspects are now in custody. Mayor Quinton Lucas says the White House and federal agencies have offered assistance while President Biden renewed his call for an assault weapons ban. Shares of Deere are sliding after it cut its profit outlook for the year. The company saying farmers are buying fewer tractors due to falling crop prices. Deere is seen as a bellwether for the agriculture industry, but the machinery maker has been under pressure due to declining income in that same sector. The company's forecast cut came as a reported first quarter earnings that actually beat estimates after it increased costs for its equipment. For the second time this year, a U.S. company is embarking on a mission to put a spacecraft on the moon. The Nova C moon lander, built by Houston-based Intuitive Machines, took off from the Kennedy Space Center this morning on a SpaceX rocket. It will attempt to land on the moon in about a week, and if successful, it will be the first privately built lander on the lunar surface. The mission comes after failed attempts by companies from Israel and Japan. That's your Bloomberg Brief. Lisa?
Yahaira, thank you so much. Up next, a bumpy road ahead for electric vehicles.
We think 2024 is probably a bit tricky year But 2025, you will see again the thing picking up because everybody will have to match the targets in 2025.
That's next. You're watching Bloomberg Surveillance. This is Bloomberg Surveillance. Welcome back on retail sales Thursday, as well as jobless claims. We do see a bit of a lift to markets ahead of all of those. We see about more than 0.1%, crossing that 5,000 line. Yields just a touch lower. The euro gaining versus the dollar. Crude off as people still see supply as overwhelming demand. Let's get straight to it. One of the key questions has been the auto manufacturers and a bumpy road ahead. So under more surveillance this morning, a bumpy road ahead, not just for all vehicles, but electric vehicles in particular.
We think 2024 is probably a bit tricky year, but 2025 you will see again the thing picking up because everybody will have to match the targets in 2025. So that's my view on the thing. We shouldn't doubt about the fact that EV will be a dominant technology in Europe. Maybe not the only one, okay, but it will be very, very strong, I think.
Here's the latest. Stellantis rising after the company announced a €3 billion buyback. The maker of Jeep vehicles warning of a, quote, pretty turbulent year ahead, facing higher costs, a drop in market share, and softening demand for electric vehicles. Joining us now, I am so pleased to say, is Stellantis CEO Carlos Tavares. Carlos, when you talk about a turbulent year ahead, is it because of a lack of demand? Is it because of competition from China? Is it because of politics? Or is it because, frankly, people are just pushing back against pricing?
Well, I think it's because all of the things you said, but we did not say it was more turbulent than 23. We said it was turbulent, which means, our industry and specifically Stellantis is now used to manage turbulent situations. It's obvious that from an economics, a geopolitics, technology, offensive of Chinese competitors, we expect 2024 to be quite turbulent, indeed, quite dynamic. But also that Stellantis is all about sports. It's all about racing. It is in our DNA to race, which means we like turbulence. We like because it's a very competitive period in which you can demonstrate eventually that you are better than the other guys. So we like turbulence as an opportunity to show competitive edge for the company.
And we can get into that in just a minute. I am curious about some of the increased costs, in particular due to some of the labor negotiations that we've been seeing in the United States. I'm just wondering from your perspective how that's featured into some potential cost cutting or other measures to try to offset some of the higher fees.
Absolutely. You see that what is the most important for us is that we deliver on our mission, which is to offer safe, clean, and affordable mobility. This is our mission. Right now, we know that we have a challenge on affordability. Affordability means that we need to absorb the additional cost of the EV technology. It's around 30 to 40%. So we need to absorb it. And we need to absorb it by a better design to cost, by more efficiency in everything we do, in our plants, in our supply chain, in our logistics. We need to make sure that at the end of the day, when we go to market, we have the most optimized strategy in the way to go to market. All of this is creating a huge area for optimization to accelerate the productivity that will mitigate the additional cost of the technology in order for us to make it very simple to sell BEV cars at the price of ICE cars. This is the mission we have, and we expect to work very hard on that. The good thing is that as we delivered record results in 2023, we at the same time recognize that we did not do everything right. So all the things that operationally we did not do in a perfect way in 23 represent as many opportunities to do it better in 24 and contribute at one point in time to bringing BEV products to the market at the price of the ICEs. That's our mission.
Well, to get to that mission, does this mean more layoffs of people in the U.S. to compensate for some of those wage increases that happened at the end of the year?
What it means is that we are in a transformation. perhaps it's good that we take a few seconds to explain that a transformation is not an addition, which means as we are expected to transform our industry to a more automotive tech-oriented industry with zero-emission vehicles, what we are going to do is we are going to transform. Transform means less here and more there. Let me give you an example. We have been creating a very significant brand new division of software engineers with more than 4,000 software engineers just to take care of the infotainment, take care of the new electronic architectures, and make sure that we bring all the services in the car that the consumers are expecting from us. So we are creating tons of jobs on software engineering. We may need less in other kinds of technologies, like, for instance, internal combustion engine technologies. So transformation means it's not an addition, means it's a change from what exists today to something different. This is what we are somewhere instructed to do in this very significant transformation of our industry.
So, Carlos, can we discuss the further transformation? The market is tuned in here this morning, and they want to know where you and the chairman are. You're throwing off cash, up the dividend, great for the shareholders this morning. The market expects you to produce $30 billion in net cash this year. What the market will want to know is how aligned are you with John Elkann? You've both been on the tape. You're talking about M&A, he's pushing back. There are no plans being studied regarding mergers of Stellantis with other manufacturers. You're the CEO. We know you're an advocate of M&A. How aligned are you? Are you actively lobbying John to engage in M&A? Are you at odds or are you together?
I think you just have to read carefully what was said by the company and by our chairman in the sequence. The company said when those speculations, which by the way are pure speculations, when they appeared, we said there is nothing ongoing. There is a statement, a press release from the company at that point in time. 24 hours later, the chairman, John Elkann, confirmed the same way. So I don't know where you are seeing any kind of misalignment. I just see a perfect alignment on those statements. So I want to confirm that indeed there is a perfect alignment. There is no ongoing M&A discussions. There is the perfect recognition that in the future, the companies which are not fit to face the Chinese competition may put themselves in trouble. We are not among those ones because we are one of the most profitable OEMs on the planet. So we expect to stay healthy because if those opportunities were to come, then we'll be there eventually. But at this stage, I can confirm, as we did in a statement that was confirmed by the chairman a few hours later, that there is no ongoing discussion on that matter. So there is no misalignment and there is no M&A discussions right now. That was a pure speculation from a certain number of media, and you know perfectly well where it's coming from.
Carlos, just quickly here, I am wondering, though, if you're basically saying that even without M&A, without making any acquisitions, Stellantis can compete on the electric vehicle front with China, given the current structure.
I think we can. The only open question will be the speed at which we are going to progress. I think we can. I think we have enough ideas. And we have enough things that we are not doing perfectly well, that we could do better. I think that our supply chain has been changing significantly in terms of more vertical integration that gives us more cost competitiveness in everything we do. So I think that when we look at the pool of ideas that we have to bring the cost of EVs down to the level of ICEs is quite large. And of course, we are embracing that. I would say in a very exciting way, because we want to get the job done very quickly. Then are we going to be able to do it as fast as we wanted to? That's something we'll see in the future. But there is a very important thing you can see already now, is that in the European market, we are bringing the new EC3 Citroën at 23,300 euros, let's say $25,000, with a mid-trim, with the full equipment and features, and that car is perfectly fit to face the Chinese competition. So we are already there, and that car is sold with some profit. Not as much profit as we would like, but it's already there. So we are getting there, and we expect now to accelerate.
Carlos Tavares, unfortunately, we have to leave it there. Celente, CEO, thank you so much. This is Bloomberg. An hour until key economic data in the U.S., jobless claims as well as retail sales. Right now, you're not seeing much drama in markets as they continue to claw back gains after that hotter than expected CPI that for a moment created some turbulence, and then it was a dip that everybody bought. Climbing above 5,000, S&P futures 50.25. NASDAQ also gaining. Russell 2000 outperforming up 0.8% as people retrace some of their higher for longer kinds of bets, which you could see in the currency space and in the bond space is similar. In the bond space, 2-year, 10-year, 30-year, all yields lower, although marginally so as people look to what we get in about 60 minutes time. 10-year yields 4.22% rounded up to the nearest tenth. And I got to say, this is kind of where we're at this morning. Not a lot of drama. And the euro gaining versus the dollar after quite a bit of weakness, gaining just a touch here, 107.44. Let's get straight to it because we have a fantastic guest coming up. Under surveillance this morning, Republican presidential hopeful Donald Trump considering a NATO makeover if he wins a second term in office, with guarantees only provided for nations that hit defense spending goals. This, according to Bloomberg reporting. Trump advisors also discussing getting Ukraine and Russia to negotiate an end to their war. This comes as Russian President Vladimir Putin praised Joe Biden as being better for Russia than Trump. Putin calling Biden a, quote, predictable old-style politician, seemingly trying to pile on to other concerns maybe about his age. What do you make of that, the Putin comments, Annmarie?
Well, what I find interesting is that last time I was in a room with Putin, with our editor-in-chief, and we asked about this, it was ahead of 2016 election, and it was Hillary Clinton versus Trump. He did not want to weigh in on it, and he said he's willing to work with anyone. There has been some reporting we've had that people in the Kremlin have found that they didn't understand Trump, so it was too unpredictable, where Biden potentially would be a more predictable path. But also, this is just likely Putin trying to weigh into U.S. politics because that's what he does.
All right. Well, I'm sure we can expect more of that in the election that everyone is incredibly excited to talk about for another 9 months. Meanwhile, fresh data showing the UK slipped into a mild recession in the second half of last year. GDP falling 0.3% in the fourth quarter, marking the second straight quarterly decline. Japan also slipping into recession, at least technically, pushing back bets on when the Bank of Japan will end its negative interest rate policy. GDP falling 0.4% in the final quarter. Economists, get this, had been estimating growth of 1.1%, a pretty big miss, Manis. And you would expect there to be a pretty big sell-off in stocks because that really raises concerns about the health of the economy. And no. Yeah, exactly. Yeah. So just it sort of speaks to this Teflon feeling that we have in markets.
Two things. The rates market did move. The rates market did react. It went from 60 basis points cuts to 79 basis points. We had Gilles Mouek with us just a short time ago, and he said, look, looks like a recession, but it certainly doesn't feel like a recession.
Which is the reason why people are maybe looking.
Well, they've still got jobs.
They've still got jobs. And so there's raises this question of what is the monetary impulse and response, which we will get into in a little bit. Meanwhile, the stock that keeps on giving, NVIDIA's market cap surpassing Alphabet's, rising to $1.83 trillion as the chipmaker's AI-fueled rally shows little sign of slowing. The stock up almost 50% this year, making it the best performer on both the S&P 500 and the NASDAQ 100. Basically, the best performer ever, anywhere, all the time. And NVIDIA is now the third largest U.S. company behind Microsoft and Apple, which raises this question. And Manis, you were really interested in this, as was I, rightly so, when Julian was saying that the NVIDIA earnings next week could single-handedly shake the enthusiasm that we've been seeing in markets.
Look, to use a phrase, when you put an order in, it can either fill or kill the emotion of the bid and the offer here. That's it. It's going to fill or kill the AI trade. Temporarily.
Yeah, maybe, exactly. And as long as they beat above, 20% more than people were expecting, everything should be fine. But basically, if they just come in line, that's going to be a massive miss. We want to shift to financials because there have been so many questions around some of the regional banking sector. The regional banks down more than 10% this year amid souring loan loss provisions and weakening credit quality, as well as concerns about an inverted yield curve. The sector under pressure with regulators targeting roughly 24 banks for their portfolios of commercial real estate loans. Among those facing scrutiny, Valley National Bank, the company saying this: we remain comfortable with our diverse and granular commercial real estate portfolio, adding, quote, as always, we value and benefit from regular dialogue with our regulators. We are so glad to say that Valley National Bank CEO Ira Robbins joins us now. Ira, could you just talk about what people have wrong when they talk about the concentration of commercial real estate on regional banks, and this being a really significant concern?
I think everyone tends to look at a commercial real estate loan and assume it's the exact same type of loan, the same type of borrower, same type of structure, et cetera. Reality is every single commercial real estate loan has some different nuances associated with it, whether it's an office loan, whether it's a multifamily loan, whether it's a single purpose loan for an owner-occupied individual looking to just support what his or her doing for their individual businesses. The geography makes a significant difference as well. The size of the loan makes a big difference. You know, at Valley, our average office is only $6 million in size, which is a very small type of loan. Really, it's just a doctor in an office in New York City. That's it, which is very different from what you see in other portfolios.
Even still, there is a sort of fear that we haven't seen the real repricing in real estate, given the stasis that we've seen in the market. How much have you had to reprice assumptions of your holdings at a time where mortgage rates have skyrocketed and you see a real lack of demand, particularly in urban areas?
I think it's a really great question because there's a bunch of different variables that run into a repricing scenario. One is just sort of where the interest rates are, where cap rates are. The other is behavior, right? So what's happening from a behavior perspective? Are people putting back into the office? You know, are people changing behaviors as to what size offices that they want? Those are harder things to sort of determine when you're looking at the repricing risk. For Valley, we've had $2.8 billion of loans repriced in the last 12 months or mature. We have not had to restructure one loan at that whole $2.8 billion. Other portfolios of some of our peers have had to restructure those loans based on interest rates, based on behavior changes. So once again, it goes to the uniqueness of each individual organization, how they underwrote, the type of borrowers that they have. But every commercial real estate loan is not the same.
Good morning. Good to see you. And again, we sit in this Bloomberg room and we talk about commercial real estate and we talk about the pressure that it can be brought to bear on the real economy. So put it in context. You know, you're lending. What have you brought the credit committee together and said? Have you changed the credit rules? Have you tightened things up? Have you given the credit team a new definitive line, which is tighter, smarter? Let's pull back. What is the message that you've given to the credit committee?
Look, I think credit across the entire space has definitely pulled back, right? And I think that's some of the things we're looking at. I think the stress tests that we do, historically, we run 200-300 basis points of stress tests. Mm-hmm. So today's interest rate environment's 5-6% on wherever rate that we're doing. We're now saying, hey, instead of just testing 200 basis points up, now we're testing 300 basis points up. You know, at Valley, I think we were always concerned about what happened with the actual cap rates, right? We had cap rates get down to 3%, which is crazy. We floored ours at 5%, which I think makes a different type of borrower that we were looking at. So I think we're trying to be more granular in what we're looking at.
Okay. The issue is this. It's about the loan book to capital. Now, my understanding from what I've read, and this is one of the moments when CEOs will possibly correct me on the percentage, you 550%, your commercial real estate book is 550% of your overall capital. Mm-hmm. Are you comfortable with that? Are you really comfortable with that? Are the regulators comfortable with that? Have they come in and said, this is excessive? Convince the market this morning that's the right number.
I think that the regulators have for us rules that say once you get over 300% in capital, as you're describing, you have additional scrutiny that needs to be performed on that portfolio. We've been with the OCC for many years. They've looked at our portfolio. There's heightened standards associated with it. You know, for us, it's the granularity that sits within that portfolio, right? We only have $421 million of rent regulated in New York City, right? So once again, the type of concentration that you have is very, very different. Almost 200% of that concentration that you're talking about is for owner-occupied. So those are actual borrowers, right? It's their own cash flow that supports that commercial real estate payment. Very, very different than what it is at other organizations. And I think it's important to have a good dialogue with your regulators, have them understand what goes on. So we feel we have a really good dialogue and not much concern.
But are they taking a closer look at you than in the past they otherwise wouldn't?
I think, look, a regulator has to do their job and understand what's going on in the market. And if there's heightened concern, scrutiny associated with a specific segment, they're definitely coming in and spending more time looking at that. But you know, I don't think it's anything out of the ordinary versus what would have happened if there was more concern within another sector.
When you take a look at the way that some Congress members are trying to propose new regulation, you laugh. Why are you laughing?
To me, it's an unbelievable irony as to sort of how we're thinking about regulation across the banking sector today. I mean, if you were to look at a banking sector and say, what do we want for 2024 and how do we think about growth? And we sat there and said, we want to make sure that every consumer business has an opportunity. We want to make sure that there's a diverse banking system across our country to support entrepreneurial and business growth. Is this the regulatory structure that you would create? And the answer would be absolutely no. Right? We have an FDIC that's responsible for regulation. We have an FRB that's responsible for regulation. OCC that's responsible for regulation. CFPB that's responsible for regulation. For credit unions, NCUA that's responsible for regulation. It is a challenging environment, and especially when you're in the banking industry, where an industry is focused on a confidence of trust, right? If there's not trust within an industry, then people are concerned about keeping their deposits at specific banks. And when you have such a bifurcated regulatory environment, one weak link creates that confidence of trust.
Are you saying that if some of the regulation that's currently being proposed goes into effect, that you expect a number of smaller banks to go out of business?
I think we have real challenges with the granularity of what our diverse banking system looks like. You look at Canada and some of these other countries, and are they really better off by only having a few large banks? Business growth in those countries is not as dynamic as what it is in the United States. Development of entrepreneurs is not as dynamic as what it is in the United States. The ability to get a loan in our country where you don't have to fit into a box is done by banks like Valley, is done by banks that are smaller than us. And when we don't equal a level playing field across our industry based on the dichotomy of what's going on with regulation, it's bad for the U.S. economy, it's bad for jobs, and it's bad for the future of our country.
Well, I mean, that's a lot on regulation. The one thing that we debate again in this room and in this house is about where the Fed goes, and that has got a direct consequence. I'm curious to know whether there's like a pent-up level of demand out there for these rate cuts to come through. We see lots of memes on Instagram. There's this horde of people waiting to borrow when these rate cuts come. Talk us through your thesis in terms of the strength of the business without rate cuts and what could come if we get 3-4 rate cuts this year.
I think just look at the slope of the curve, right? We are in an inverted curve. I like to sit there and say that it's
the longest in history almost.
But it's a full moon, right? You have crazy actions that happen when you're in full moons, and that's what's happening in the inverted curve. Banks' business models were not made to make money in an inverted curve. And it's the longest, as you said, for how long
almost
now?
In history.
Right, so I think any type of normalization of the slope of a yield curve is going to be positive for the banks, whether that's long end coming down, or whether that's the long end going up or short end coming down. I think the banking environment and the country will do better when there's a normal sloping yield curve term structure of interest rates.
The problem is that a lot of the things that we're talking about right now, you don't have a lot of control over. You don't have a lot of control over the shape of the yield curve. You don't have a lot of control over appetite for real estate in certain areas. So how do you try to survive and thrive and make money in an environment that's stacked against you?
I think it just goes back to what creates franchise value within an organization. I used to run the asset liability management at our organization, and I always said, I'm not creating franchise value for our shareholders by taking a bet on short-term or long-term interest rates. Franchise value is a function of the new clients that you bring in and the relationships that you have. So that's what our focus is. We try to be as neutral as possible when it comes to managing the interest rate position, but once again, it's hard when you're in an environment that's an inverted curve. So for us at Valley, we grew 4.5% consumer households this last year, 10.6% commercial households this last year. So though it's a challenging interest rate environment, without question, franchise value growth is definitely happening.
And we're going to go just to that point in the upcoming segment. We want to talk about commercial real estate, or not just commercial real estate, but also commercial lending and retail lending at a time where the U.S. consumer seems to be very strong. Ira Robbins of Valley National Bank is going to be sticking with us. Right now, let's get an update on stories elsewhere in the world. Here's your Bloomberg brief with Yahira Hakis. Yahira.
Hi, Lisa. Job cuts on the way at Morgan Stanley. The bank plans to slash several hundred jobs in its wealth management business. That would affect less than 1% of employees in the group of about 40,000 workers. The cuts will be the first under new CEO Ted Pick, who took the helm in January. Morgan Stanley cut more than 3,000 jobs last year as the bank looked to reduce expenses amid a drought in deal-making. Colorado is the second state standing in the way of Kroger's $25 billion acquisition of Albertsons. State Attorney General Phil Weiser is seeking a preliminary injunction that would prevent the deal from closing. He says the merger would leave Colorado communities with less access to groceries. The move comes just a month after Washington filed a lawsuit over the deal. The FTC has been reviewing the proposed takeover for over a year. And Airbus is planning to deliver about 800 aircrafts this year. That's slightly lower than analysts expected. The plane maker striking a cautious tone as supply chain issues persist. While investors had hoped for a more ambitious output, the target will see Airbus pull further ahead of rival Boeing, which was forced to cap its delivery plans after an accident that saw a fuselage panel blow out during a flight. That's your Bloomberg Brief. Lisa?
Yahira, thank you so much. Up next, AI driving NVIDIA higher.
The AI revolution's playing out. This is the biggest tech trend since 1995. Who's leading it? It's the godfather of AI, Jensen and NVIDIA, along with Nadella and Redmond. And now this tidal wave is coming.
Up next, we're going to talk about Dan Ives and his incredible wardrobe, which he wants to give fashion advice to Jonathan Ferro when he returns. That is next. No, that's not what's next. You're watching Bloomberg Surveillance. A day of U.S. economic data as we try to figure out whether we have to care once again about a CPI print that came in hotter than expected. Right now, nobody's caring too much. You're seeing a bit of a bid into stocks as well as bonds. It's the everything rally sort of tepidly. Not a lot of drama here. A bit of a dollar weakness. Euro strength 107.46. Crude off just a touch as we do get information that maybe supplies really are going to continue to outweigh demand, down about 0.6%. Under surveillance this morning, guess what? AI is driving NVIDIA higher.
The AI revolution's playing out. This is the biggest tech trend since 1995. Who's leading it? It's the godfather of AI, Jensen and NVIDIA, along with Nadella and Redmond. And now this tidal wave is coming. We expect next week, whatever the knee-jerk reaction is, this is going to be just another massive quarter that shows monetization of AI. It's here.
And I think a lot of people are banking on that. The latest is NVIDIA's market cap reaching $1.83 trillion, passing Alphabet to become America's third biggest company. No one heard about it a couple of years ago. The stock up over 49% this year ahead of its earnings due out next Wednesday. Drum roll, please. Joining us now, Mandeep Singh, senior technology analyst at Bloomberg Intelligence. Could this shatter the market rally and perception? Or, as Dan Ives said, is it going to be just another blockbuster that we can chalk up in the books as another way up to double their value?
I mean, in terms of their quarter, I think they're probably going to deliver a good beat and raise as they have done in the last few quarters. The question still remains, right now the market is treating everything as an AI tailwind. And, you know, there are a lot of incumbent companies like Intel. We saw with Cisco last night, they missed. They're going to get cannibalized in terms of their existing chips that they sell. And that is what is not being priced in perfectly right now, given, you know, everyone is bullish on AI. They can see the incremental revenue in Microsoft and NVIDIA, but overall IT spending doesn't grow 30-40%. Yes, AI spending will, but it's going to come at the expense of existing IT revenue, and that's what I think the market still needs to figure out.
But then is this where the margin comes in for NVIDIA, which is in terms of what they deliver relative to their peers? It's you choose their product because of the, let's say, productivity uplift that you get with their product relative to other people?
I mean, right now the market still seems so supply constrained. You look at, you know, at the company level, what the hyperscalers are doing in terms of CapEx, what the governments are doing. Now the governments are looking to build their own LLMs because they want proprietary, you know.
Well, that's about security, isn't it?
Exactly. And so there is insatiable demand. And right now, I would argue NVIDIA is probably over-earning when you look at, you know, the long term, what they're going to earn 10 years, 20 years down the line. The normalized level of earnings would probably be lower than this. But they are setting the bar so high, and they keep beating that, and it's going to continue probably for a couple of quarters.
What is it that could cause NVIDIA to not fall, but to trip? You know, what is the road ahead for them? Is it capacity? Is it constraint? What is the constraint that NVIDIA may well face?
That hyperscalers are developing their own chips, and they want to use their own vertical integration. Think of what Apple has done with smartphones.
Right.
They use their own chips for the devices, right? And that's what they're going to do at the device level. At the data center server level, which is where we are seeing a massive refresh cycle, that's where these companies, the hyperscalers, Amazon, Google, and Microsoft, they ideally would want to use their own chips for training their large language models. The governments will still buy from NVIDIA, and NVIDIA still has that software layer which kind of gives them the ubiquity in terms of, you know, being used anywhere in any data center. But I would argue, given the pricing lift we have seen for NVIDIA chips, these companies don't want to spend, you know, 10% of their capex every year on just buying from NVIDIA.
Mandeep Singh, Thank you so much, as always, of Bloomberg Intelligence. We will, I'm sure, be catching up with you, if not tomorrow, then the day after, as we really chart this trajectory upward and beyond. Ira Robbins of Valley National Bank still with us, which I'm so pleased to say. Before we get into some of the lending picture, et cetera, I want to just ask about AI and how it's transforming your business model, if you're adapting any kind of significant tech changes, or if it's still sort of theoretical at this point.
We definitely have a group within the organization that's focused on AI. I think technology and process improvement is something we focused on. When I took over as CEO, we were 3,325 employees, $21 billion. Today, we're $62 billion and under 3,700 employees, right? So being able to take technology and embed it within an organization is really critical to the future growth and the franchise value. That said, I think AI still needs to be played out. I think there's a lot of concern from the regulatory perspective about what that does from a fair lending perspective, how you're making decisions across the organization. So I think it's a bit more hype at this point until you see the actual input that's going to sit there and begin to be used within each organization.
Interesting about the fair lending and some of the inputs and the models and how you examine that. I am curious, when you talk about lending, you have increased your consumer book quite a bit. Are you seeing the same resilience and strength that we keep talking about in some of this data in the underlying performance, delinquencies, and defaults underlying those loans?
We have a lot of residential mortgage loans on our books. We have a lot of consumer loans, largely through the auto book that we have. Delinquencies have upticked just slightly. I think the consumer is a little bit more stressed than what they were before. But as long as employment's strong, I think there's a resiliency that sits within all of the consumers. So while we've seen a little bit of an uptick, they were really on anemic numbers to begin with. So I think we're in pretty good shape.
But what do you say when you see Americans now owe more than $1 trillion? This is the latest data we have on their credit cards. I mean, how concerning is that for delinquencies?
It's scary. I mean, I think we were talking about auto loans before you had someone on that was describing sort of what's happened within their own individual income, right? So the auto industry's really changed. When you go and buy a car today, typically it was a 5-year, 6-year loan. Now we stretch that out to 7, 8, 9, 10-ish years in some cases. Consumers are focused on a payment. $700 is the average payment today for an auto loan. That's a lot of money, right? And I think credit across the entire country, whether it be through autos, whether it be through credit cards, are extending and creating the ability for the consumer to continue to live in debt. At some point, there's a day of reckoning, though.
Your job, in part, is to manage risk, grow the business. You see Jane Fraser taking a massive construct. I mean, Citi's been in constant change since I was a child, but she's doing massive change. Major CEOs of major banks in America are going through change, dropping off on wealth management side. Where's the opportunity for you? Are you happy being who you are? Is there an acquisition trail for you? I mean, you may well use the bolt-on acquisition model, but as distress points come in this commercial real estate market and more shoes will drop, are you prepared to sort of stand up and do a deal? Is that your ambition? Is that what you want to do?
Yeah, I mean, we serve our clients. We've been around for 100 years.
Does that mean doing a deal?
Yeah, we make loans. We'll do $2-3 billion of loans this year. All right, we are out there actively still growing the organization. We serve our clients. We've been around for 100 years. We've never had a losing quarter in 100 years, right, with a focus on making sure we serve our clients. Relationship banking. There's only 11 banks our size in the entire country today. So when we ask about are we the right size? Do we serve a purpose? The answer is absolutely yes, and I'm excited about the opportunities for us.
Ira Robbins of Valley National Bank, thank you so much for being with us. Come back soon. Coming up, we've got Liz Young, Head of Investment Strategy at SoFi, Rob Waldner, Chief Fixed Income Strategist at Invesco, Veronica Clark, Citi Economist, and Scott Keogh, Scout Motors CEO. It is an offshoot of Volkswagen and is looking to create some electric vehicles at a time of incredible transition. We just were speaking with Stellantis' CEO. Right now in markets, you could see that lift continuing as people take a look at the earnings, take a look at the growth, take a look at the strength, the spending of the U.S. Consumer, and keep buying despite concerns about interest rates. Yields lower as people pare back some of those inflation expectations, and crude lower as people take a look at supply that continues to dwarf all demand. From New York, this is Bloomberg.
If you look at the Fed, they've been talking about patience, the need for more time, the need for more data.
We still think the Fed will begin cutting late this spring or in the summer. But again, it's just not going to be a straight line.
We think that the Fed is probably going to be on hold here at least until June.
What we're looking at going forward is higher for longer rates, less rate cuts than the market expects.
There's quite a bit more data to come before you get to that June FOMC meeting.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
29 minutes and 20 seconds away from the key data point of the economic dump that we've gotten so far this week. Good morning. Welcome back from New York City for our audience worldwide. This is Bloomberg Surveillance alongside Annmarie Hordern as well as Manus Craney. I'm Lisa Abramowicz. Jonathan Ferro off for a well-deserved couple of breaks. I'm not going to call it a sabbatical. I'm not going to say that he's ditching his duties. I'm going to say it's a good thing to take time off when it is deserved. Right now, we are looking at markets that really are kind of treading water, little bits of gains, a sense of positivity, yields off some of their year's highs. But honestly, Manus, to me, the retail sales number is going to be incredibly important given the incredible strength that we've seen so far and the upside surprise after upside surprise in economic data.
You're going to need the retail sales number to corroborate the dispensing with the showdown that you had in the bond market earlier this week on Wednesday on the back of the CPI. So you had that disruptive moment, hashtag hot according to UBS, it was hashtag hysterical response. So you're going to need a strong retail sales number to help you with this tailwind through.
A strong, but not too strong, a Goldilocks, right? This is sort of the question.
You can't have everything, Lisa. You can't have it all.
We could try, and that seems to be what markets are looking for at a time when there is this expectation of retail sales at a headline number coming in actually negative, which would be good, given the fact that people are looking for a softening without some sort of mass layoffs. So if you get an upside surprise, when is it too much, man? It's a good thing.
Well, Gillespie came out, he came out yesterday, really, I think to, send a message that, look, we don't need to get fully to 2% before we start cutting. And actually, can everybody just calm down, please? It's the PCE that matters, not the CPI. And we've had various people react to that. And Mohamed El-Erian is one of those people who has said, that is a folly. That is a folly.
I'm calm. I'm very calm. I am concerned, though, always, because I'm looking at jobless claims and I'm trying to figure out whether we continue to see a labor market that hangs in there and whether this is somewhat dissonant, right? At a certain point, if people have jobs and they feel good, they're going to go out and spend, and that creates a potential tailwind to inflation, which is not good. So at what point do you start seeing concerns about a labor market that otherwise have been incredibly strong?
That's a big question, right? Especially for this White House. When you look at unemployment at 4% or below for 2 years, they know that inflation is hurting American consumers. This is something that they're trying to stem out, especially when they talk about the economy is doing well. What happens if people start to lose their jobs? Then you have higher inflation at the same time, also people losing their jobs. So at the moment, people are at least we are seeing some layoffs, but the data is showing that is still a resilient economy.
What I find fascinating is the difference in generations. And that's why I'm actually really excited talking to our next guest who focuses more on younger investors. And I have to say, if you see younger households, we talk about, doom buying and things of that nature because they can't afford to buy homes because the prices are too high and mortgage rates are too high as well. Annmarie, how is that coloring the political discussion as well? Because younger households haven't been able to have and enjoy the same kind of boom of investment returns, of a certain level of housing equity and other types of benefits that this market has provided.
It's this younger generation that's put a lot of pressure on this administration to do things like student loan buybacks, or student loan relief, student loan help. And they're pushing the administration to do more. And they're basically saying to the Biden campaign, we need to see more equity, we need to see more relief, get on the property ladder, be able to pay back our loans in order for us to vote for you. So it is a big deal when you turn about messaging of the economy. There is a bifurcation.
And right now, the bifurcation is playing out in markets as sanguine feel as we head into about an hour and a half away from the trading day. A lift across the board as we retrace from the worst sell-off of the year, at least for the Russell 2000. Quick blip, and then that hysteria died with a quick rebound. What we're seeing right now, S&P futures crossing 5,000. 85,000, up about 0.1%. Euro gaining some ground versus the dollar, but honestly, a somnolent pair as people play the rate game, the cross-Atlantic rate game, 107.44. 10-year yields, no drama there, down about 3 basis points, 4.22%. And crude lower as people parse through the, 13 million barrels of supply from the U.S. and how that's dwarfing potential demand in places where there is greater weakness. Coming up on this program, SoFi's Liz Young on Wall Street's rate cut reassessment, Scout Motors President and Chief Executive Scott Keogh on the brand's EV revival, and Citigroup's Veronica Clark reacting to breaking U.S. jobless claims and retail sales data as we look ahead to when this economy will disinflate. We begin with our top story, counting down to key economic data, retail sales and jobless claims coming in less than 30 minutes. Investors hoping the data will provide more clues on the Fed's path forward. SoFi's Liz Young saying this. Just a few short weeks ago, markets were expecting a total of 6 rate cuts beginning in March. Current pricing shows 4 cuts, not beginning until June. That was fast. Stocks have not yet shown much fear over delaying the first rate cut, nor the persistent yield volatility, although I do find this peculiar. The reality is people are still buying, or at least, the very least, they're holding. Liz, I'm pleased to say, joins us now. Liz, do you think that this is sort of a sign of the strength of what's to come, or do you think that this is a cautionary tale of overexuberance?
Well, I think if you look at just the state of the state right now, there is a lot of very classic late cycle behavior going on. And obviously, we've seen a resilient market, perhaps not as strong of a rally as we saw at the end of last year, but resilience in the face of what would have been considered bad news. So the rally at the end of last year predicated mainly on the idea that we thought the Fed would come back and pump liquidity in, lower rates starting in March. And investors got really excited about that because it sent the message that we could then support valuations at this level. So slowly in 2024, we're chipping away at that thesis. Can we support valuations at this level? If cuts come later in the year than we were expecting, I would say the answer to that is probably no. Some of the data, however, continues to be strong. We've got GDP data that continues to be strong. So at this point, investors haven't yet gotten enough bad data to feel like they needed to exit markets. That's why I say there's still buying appetite there. If even just after what's happened this week, we saw that huge sell-off on Tuesday in reaction to CPI, but that was it. It was one day. It hasn't recovered all of it yet, but you did see some buying come in even at the end of the day on Tuesday, and then we had marginally up yesterday. We look like we're going to do okay this morning so far. So there hasn't been this lasting fear that's baked in yet.
And you're basically suggesting that people should be a little bit more worried, that there will be more ripples felt if rate cuts are pushed out, and if you do expect higher for longer. What's been the response when you tell people to be more cautious?
You know, it's interesting. I think intellectually, people agree that we're not really sure what's happening. And frankly, if you look at 2024, it feels like the uncertainty this year seems to be higher than it was last year and even in 2022. At least we knew in both of those years what path we were on from the Fed. 2024 seems to be very uncertain, and we're hanging on data that we haven't paid as much attention to in the past. So now we're hanging on labor data. We're hanging on consumer spending data. We're a little bit concerned about credit card delinquency rates that have been rising. So I think people agree with the idea that they have to be more cautious. But again, this late cycle behavior in the market just breeds FOMO. And you watch these stocks run up and everybody still, it doesn't really have a reason to not believe in the momentum train. So momentum has been very, very strong. Investors continue to see that. And there hasn't been a big enough reason to jump out of the market and not take part so far.
Liz, good morning to you. And I think one of the phrases that we had over Christmas time on this show was weaponized FOMO, and it really does feel like that. We talk about jobless claims, we'll get those, we'll get the retail sales. So they are uniquely important fingerprints of what's going on in the economy. But then I just wonder, have stock reports almost taken on similar kind of heft? We talked about NVIDIA over the past couple of hours, up 49% on the year, taking over Alphabet, taking over Amazon. And it has got the capacity to shift this sort of exuberance at the Magnificent Seven level. Do you think that this is a dangerous sort of zeitgeist in the market where we are, that we're going to be so focused on one stock, one report, defining our sentiment?
Well, that much concentration is always a little bit dangerous. And yes, I would caution investors, especially in some of those names. I think the Magnificent Seven has now turned into the Magnificent Four. But when you're looking at even just those four, and there's been this huge run up, you've got triple-digit gains in those names, it is something to take heed. You should make sure that you're not overly exposed to that. But here's the good part about hinging on some of these reports. We want the market to trade on stock fundamentals. If that's the case, I think that's a much healthier market environment than a market that's overly sensitive to every single macro data print. The other piece of that is if NVIDIA, for example, in the space that they're in, let's say they come out and give guidance that's different than people were expecting, the risk, because we're listening so closely to one name, is that that one name bleeds over into the entire sector or the entire industry group. And that's what I think investors are overly concentrated in. So we're hinging off one company's reports to tell us what's going to happen in the rest of the entire group. And I don't think that that's entirely the right way to look at it. So I'd like to get through next week and have it just be done, have it be over with, survive it, and then start to get back to a more rational environment where we're expecting rate cuts at a normal time, not too soon, not necessarily too late, and starting to think about, okay, what do earnings look like through the rest of the year? Because earnings expectations on the whole are still pretty lofty for 2024. I would still expect some of those to be revised downward.
I love a more rational market. I love that. The earnings are going to be driven, I presume, in part by the ability to sustain margins. One of the big arguments coming through my inbox is about wages being higher, wages, again, eating into those margins. We just saw Stellantis. We had a conversation with the CEO there. They're giving away $30 billion, and they just did a huge pay deal with their employees, the UAW union workers. How do you see margins? And I know it's different sectors, different margins, but how important will that be to solidify, if I can use that word, the rally in equities?
Well, I've had an issue with margins and the story about margins for a while now because the math of it for me just doesn't really work. If we're expecting, or if the Fed is expecting, less than 2% GDP growth, I'm having a hard time figuring out where 11 to 12% earnings growth is going to come from. And you're talking about the wage story and that eating into costs for companies. That absolutely is true. That's been able to be absorbed through 2023 and even parts of 2022 because companies were raising prices. So they were able to raise prices and raise revenue in order to offset the increased cost from wages. Now we're at a point where the cat's out of the bag, inflation has come down. So there's no more justification to raise prices. The issue for consumers is that companies haven't really dropped prices. So we're still at an elevated level. We just stopped raising them so much. But if wages continue to rise, that will eat into margins. It does pressure companies. So then they have to go back and say, if I want to preserve my margin, I'm going to have to cut costs somewhere. It's been my take that companies have cut a lot of costs already. We've seen a lot of cuts in advertising. We've seen labor cuts. We saw tech companies make a bunch of cuts over a year ago. So at this point, what's left? The things that are left to cut are typically labor. It's the last thing that companies want to cut, but that is at risk, I think, in 2024. And I heard a guest earlier in the program talking about the consumer is still spending, the consumer is still strong because the labor market is still strong. That is absolutely true. The risk with that take, too, though, is that the labor market is always the last thing to crack. So the labor market right now is strong. That doesn't mean that it's going to stay strong if companies are trying to preserve those margins. And you have to think about the entire thesis all the way through, how that's actually going to work out in the math equation.
Which is a reason why some people are more focused on jobless claims than they are even retail sales. Liz Young of SoFi, thank you so much for being with us. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahaira Hakis. Yahaira.
Hi, Lisa. According to Bloomberg, U.S. intelligence believes Russia is considering a nuclear weapon in space. The news comes after House Intel Chair Mike Turner warned the public of an unspecified national security threat and demanded the White House declassify related material. U.S. National Security Advisor Jake Sullivan is expected to meet with members of the Gang of Eight today to provide more details. When asked yesterday, Sullivan said he was unable to comment further. Bitcoin is once again powering the crypto market, climbing past $52,000. The move is part of a broader rally that sent Ether back above where it was before the Terra USD stablecoin collapse 2 years ago. Bitcoin has surged 22% year to date, pushing its market cap above $1 trillion for the first time since December 2021. Cryptocurrencies have been gaining momentum thanks to the debut of Bitcoin ETFs. For the second time this year, a U.S. company will try to put a spacecraft on the moon. The Nova C moon lander, built by Houston-based Intuitive Machines, took off from the Kennedy Space Center this morning on a SpaceX rocket. It will attempt to land on the moon in about a week, and if successful, it will be the first privately built lander on the lunar surface. The mission comes after failed attempts by companies from Israel and Japan. That's your Bloomberg Brief. Lisa?
Yahaira, thank you so much. Up next, electric vehicle makers expanding despite challenges.
Right now, we know that we have a challenge on affordability. Affordability means that we need to absorb the additional cost of the EV technology.
That's next. You're watching Bloomberg Surveillance. This is Bloomberg Surveillance, taking a look at markets with a lift with just about 13 minutes to go before key economic data. Yields lower, as is crude at a time when people are wondering about demand. Let's get straight into it. Under surveillance this morning, EV makers expanding despite challenges.
Right now, we know that we have a challenge on affordability. Affordability means that we need to absorb the additional cost of the EV technology. It's around 30 to 40%. So we need to absorb it. And we need to absorb it by a better design to cost, by more efficiency in everything we do, in our plants, in our supply chain, in our logistics.
Here's the latest. VW subsidiary Scout Motors expanding electric vehicle production in the United States as headwinds, including price, infrastructure, and mass market adoption, impact both legacy brands and startups. Joining us now, I'm very pleased to say, Scott Keogh, President and CEO of Scout Motors, in front of the new proposed manufacturing plant in South Carolina. Scott, I just want to start with why you want to get into electric vehicle making at a time when so many larger auto manufacturers are trying to get out.
Yeah, look, it's a long game, and we're not playing the short game. So I think a few wind noises, a few disruptions is not where the action's at. The market's at 8% now. It's going to move to 40 to 50%. That's millions and millions of cars. So the upside is there is an opportunity, and we want to pursue that opportunity.
You're building something in the United States, which is, I'm assuming, deliberate in response to some of the recent policies. And I'm just wondering how difficult it's going to be to compete with China at a time where costs elsewhere are more expensive, both with labor, both with also some of the actual raw materials based on where they come from.
Yeah, look, competition is what we're used to. That's what the automotive business is about. I think if you look at what Scout Motors is doing, frankly, the strategy is nearly perfect. America is a huge market. We're building things again in America, which is exactly what we're doing here. We're localizing the supply chain and attacking cost. I think the fact we're starting with a clean slate, we've got the purchasing power of the Volkswagen Group to give us good terms of trade on cost. To me, it's simple. You have to compete. But that's why we have a ground-up platform, ground-up factory, design everything to compete on cost and make a great vehicle.
Scott, good morning. Good to see you. I got to say, the design looks great. Who are you? I've done a little bit of this desert bashing, dune bashing when I lived in another country. So I sort of know the style of car, and it's great fun. Yep. But how big can this market get for you here in the United States of America? Tell me the model that you're going head to head with. Is it Ford Bronco? Is it the Wrangler? Who are you going to compete with in this space?
Yeah, I think you're certainly in the zone. Look, in my mind, there's two types of SUVs, RUVs in the market, if you will. There's mainstream, dialed to going around town, going into suburbs, going into the malls. Then there's can-do types of vehicles. Look at the high end, things like the Defender, at the more medium end, Broncos and Wranglers. What do these vehicles have? Strong community, strong loyalty.
But where are you going to make the most money? Where are you going to make the most money? At the upper end or at the, probably my end?
Right down the middle. We're building a car. We're building a car for mainstream America. We're going to price it in the zone of $50,000, and that's where we're going to make our money. And we can make our money at those price points, which is great. If someone wants to equip the car higher, then that's obviously fantastic for margins. But you have to make money on the base, not just at the high end.
To get some of the tax relief from the U.S. government, though, a lot of what you put in your car needs to be made in the United States or a U.S. ally. But when you look at how batteries are made for EVs, the entire raw materials and the supply chain to make that battery, the processing comes from China. What's the mix in your cars?
Yeah, look, we haven't fully identified everything, but I think, look, it's simple if you look at the incentives. There's the consumer side, which is what you've mentioned, then there's the industrial side, where you make it, the power, the cells, and everything else. So look, our goal is to take maximum advantage of all the incentives on the table. There's a strategic opportunity in America now. That opportunity is going to last for a couple of years, and obviously, we want to take advantage of it. Do we have every last detail laid out? No. But our goal is to seize the moment. And by the way, there's a lot of people seizing the moment. I think if you look at the amount of industrialization that's happening in America, it's through the roof. Lots of companies see it. It's a chance of a lifetime, frankly. And that's why we're pressing our advantage and pressing it now.
The Stellantis CEO recently talked about the fact that he's staying on the sidelines when it comes to how he's going to deploy the money he has for EVs, depending on the upcoming U.S. election. Do you plan on potentially changing the path forward for your company, depending on who wins the White House in November?
No, I think the North Star is the same. The North Star is build a great electric vehicle, build it in America, make a product and a brand that Americans love. That's a North Star, and that will go for centuries and decades. You can't run a business on the movements and shifts of politics, but at the end of the day, the money is going towards American jobs, American manufacturing, and I think Americans support that. And you see it across the board. So I think the core infrastructure will stay there, but we will run our business based on the consumer and based on getting the cost right, not just on political movements.
Do you think that if there were no tariffs, if there were no barriers on Chinese electric vehicles coming into the United States, that U.S. auto manufacturers could compete when it comes to selling EVs?
Look, this is conjecture and speculation. If this could happen, if that could happen. Frankly, the automotive business in America has been here for a long time. It's competed for a long time. I think if you look at the type of vehicle that we're making and the person that it's targeted for, I think they're going to love a Scout. They're going to love what we're offering, the technology that we're offering. But it's simple. You do need to compete, and we will. And there's been competitive threats that come across the globe from all sorts of countries. And I think America is used to competing, and America will compete. But the smart thing about this brand is make a product that Americans love. I haven't seen it out there yet, and that's why we're making it.
What do you think so far, Scott, the barrier has been with respect to electric vehicle sales and why they haven't taken off as quickly as so many people have expected in the U.S.?
Yeah, look, I think there's a fair amount of noise. Before you say Disasterville is here, first and foremost, 1 million of them were sold last year. That's 8% of the market. It was 0 just a little bit ago. I think there's 3 things without a doubt that we're focused on, and everyone is. Absolutely right. The double hit of material cost increase plus the financing charges. Financing alone put $250 a month on every car payment. So when we head into this, let's say, a more normalized inflation environment, look at the cost of batteries. They're going down dramatically. So cost is number 1. Number 2 is infrastructure. When we come to the market, there'll be 10 times more chargers in America than there are today. Infrastructure's there. Third and final is the standard. As you know, there's been no standard. There's 3 to 4 different ones. Now, rallying around NACS, there'll be one standard. So these are all big things. And the other one is just classic adoption. Get the cars on the road, get them seen. That's purchase confirmation, and away we go. What I haven't seen is the consumer saying, I don't like them. The consumer saying, these are cool, I do like them. So that's the thing you need to attack. The rest is classic adoption challenges. We need to address them big time.
Scott Keogh, thank you so much for being with us, President and CEO of Scout Motors. Meanwhile, we are about a minute away from, or actually about 5 minutes away from some key economic data, breaking retail sales and jobless claims. We're going to be speaking with Citigroup's Veronica Clark to react to those numbers. The expectation is for some sort of ongoing, just sort of slow grind of initial jobless claims, 220,000. We are expecting a negative headline retail sales figure, although when you strip out autos and gas, the expectation is for it to just eke out a slight gain, the Goldilocks that so many people are talking about. This is Bloomberg. Just about 25 seconds until key economic data. What is more important? And this is going to be something that we're going to be talking about. Is it retail sales that we're going to be getting, or is it initial jobless claims at a time where people say the key really is about the labor market? Right now, the expectation is for 220,000 initial jobless claims. The expectation is for a headline decline of retail sales of 0.2%. When you look across the board, the key question will be, will there be ongoing strength? Joining us now to break it all down is Michael McKee, Bloomberg economics and policy correspondent in Washington, D.C. Mike, what do you see?
Well, we were expecting bad news on retail sales, and the news is worse than we anticipated, down 0.8%. The forecast was for a 0.2 decline. About half the country was under piles of snow during January. That may have had something to do with it. Ex-autos down 0.6, and the control group down 0.4. That was expected to rise by 0.2. So not good news anywhere in the retail sales report so far. Jobless claims come in at 212,000. They drop from a revised 220. So better news on that front. Continuing claims at 1,895,000 do rise by 30,000 during the month. So people may be slower getting jobs, but that is 2 weeks delayed. So today's drop in last week's claims hasn't made it into that yet. The Philly Fed comes in higher, 5.2%. We were looking for a negative 8.1. So good news on Philly Fed. Import prices up 0.8 on a month-over-month basis. On a year-over-year basis, they're down 1.3%. So some inflation pressure on a monthly basis not working its way so far into the year-over-year numbers. And finally, in this palooza of data, Empire Manufacturing, negative 2.4, still negative, but that's better than the negative 43.7 that we saw in the month of January. So an awful lot of numbers, and what I will do here is go through it and break down some of the retail sales numbers, Lisa, while you break down how the market's reacting to all of this.
I'm looking forward to hearing what you parse through. Just taking a look at markets, it's kind of as you would expect, given the fact that you get a downside surprise. You get a lift to equities because good news is bad news. Actually, there's basically no change whatsoever because it doesn't change the picture. The Fed is going to be on a cutting bias, and that is going to give a bit of reprieve. S&P futures up still 0.1%. Same with the NASDAQ. If you could actually see a bigger pop in the Russell 2000, which is as you would expect, given the fact that it's more rate sensitive. Talking about rate sensitivity, bleed it through the rate market, and what you see, yields lower, not that much lower, but still lower than where they were on the session, down 5 basis points, 420 on the 10-year. 2-year yields, 453, down also about 5 basis points. People looking forward and seeing more likelihood that if people are spending less, maybe the Fed can cut rates sooner than maybe they were expecting when we got the CPI print. When you translate it into a foreign exchange call, you could see a weaker dollar, stronger euro, weaker dollar, stronger pound. It's almost down to flat on the day with the pound, even after the pound reeled on the face of a UK potential technical recession. 125.63 on that pound dollar cross, and the euro up a little bit more, 107.64. Mike, you've been parsing through the numbers. There is this question of it all comes down to jobs. If people have jobs, they'll keep spending. That's what everyone's been saying. So what went wrong in January that caused a much bigger than expected decline?
Well, it does look like the theory that the weather played a big role really did hold true here. The biggest declining category was building materials, home garden supply dealers, down 4.1%. I suspect that's because nobody was working outside and maybe they already had enough snow shovels. So we saw a big decline there. We see smaller declines across the board in other places. Of course, gasoline prices went down, so gas station sales down 1.7%. Furniture stores were up, however, as were food and beverage stores, up slightly, 0.1% for food and beverage stores. And then you look down the list, and general merchandise stores, department stores, little changed. Non-store retailers were down 0.8%. Food and drinking places, though, up 0.7%. So perhaps it was the weather. Perhaps it was a little bit of exhaustion from spending all that money in November and December. Of course, course, the thing to realize always with retail sales is it's very volatile. They will be revising it next month. As a matter of fact, retail sales were reported up 0.6 in the month of December. That was revised down to 0.4. So not a good start with retail sales for February, but the jobless claims numbers suggest companies are not reacting to that.
Well, let's just talk about those jobless claims. Weekly jobless claims, Mike, good morning. Down 8,000 to 212,000, so it's below the estimate. Julian Emmanuel was with us this morning. He said this is the single most important print every week that we need to keep an eye on. So this is still very well behaved, isn't it?
It is. It does give us an indication of what companies are thinking on a fairly timely basis. Of course, we have to realize that jobless claims are always revised heavily. So while we're at 212, it could easily go up or down a little bit when we get new numbers next week. And as I mentioned earlier, the continuing claims numbers really haven't moved all that much. We did see an increase in claims the prior week, and that's what that continuing claims is based on. This week we go down, so continuing claims probably go down next week. Overall, though, it does show the labor market remains healthy. And as Lisa said, people spend when they have paychecks. And that's been a reason we've seen strong spending up until this month.
Michael McKee, thank you so much. We'll be catching up with you throughout the day to understand more details as they come out. Veronica Clark, Citigroup economist, joining us now. And I got to say, Veronica, how do you make sense of numbers that just are kind of disparate? They don't necessarily cohere with one another.
Yeah, I mean, in one sense, these numbers for December and January are always going to be a bit hard to interpret, maybe because of weather, but also just large seasonal adjustment issues around the holidays. I wouldn't necessarily read so much into this weaker retail sales report. We have had a string of 6-7 months where we've been surprising to the upside. The consumer has been very strong, and maybe there's those seasonal adjustment issues, but we are watching for signs that things are starting to slow down, and maybe this is the early indication of that.
At the same time, jobless claims arguably is even more important. We're not seeing it tick up. If anything, it's coming down. How much does that color your perception of the weakening that's supposed to happen, but just hasn't shown up in things like CPI and things like jobless claims and even things with other metrics like job openings?
Yeah, that weekly jobless claims number is definitely the most important to be watching, and initial claims are still very low, and that's consistent with what we've seen for many months now. Where layoffs, outright widespread layoffs, are really not quite happening yet, at least in terms of the data. We have seen this increase in continuing claims, though, especially after the reference week for that January payrolls report. So those are ticking a bit higher, and I think that's consistent with what we've seen in hiring slowing down. If you do lose your job, maybe it is taking you longer to find work, which could be the early sign that broader things are slowing down also. So definitely still watching that initial jobless claims number. If that really starts to tick up, then that would be a turning point.
Good morning, Veronica. I'm curious to understand, you still have a call for a recession, and yet you look at the survey data, and I know you can hurl eggs at the screen on survey data, but the survey in the Bank of America Fund Managers Survey is the first time in a number of years that call for recession has ceased. So why are you at the other side of that trade?
Yeah, I mean, I think one issue is that, it comes down to do you believe, this high level of rates is restrictive or not? And we do think it is. And the longer that, financial conditions stay tight and rates are restrictive, you will see that, impact activity and see things slow down. And we did see the early signs of that really back in October, November. We've seen the unemployment rate ticking up very slowly, hiring slowing down, hours worked that are falling, all those early signs that you would expect to see, 6 or 9 months before a recession. And we're really watching the data for the spring to see if that turns around. Again, because some of this December, January data has issues with seasonal adjustment and it might be hard to read into. But nothing has convincingly, told us yet that weakening isn't happening.
We've had severe whiplash this week in equity markets, bond markets, and we've been guided by the Fed that the only thing that matters is the PCE, or it is perhaps the more important facet for us to keep an eye on. Should we completely ignore what happened in CPI and go, it's a one-off, it's not where we should be focused?
No, I don't think that's right. I mean, I do think, we did see some pretty genuine strength in CPI. And yes, the Fed is targeting core PCE inflation. We've had about 6 months where that's running at around, 2%, 1.9. That story, though, might change in 2 weeks when we get a stronger PCE report for January now, because those elements of strong CPI are going to go into that PCE number. But I do think, we saw some pretty genuine strength, just very consistent, strong services inflation. And that's in, shelter prices and non-shelter services. I think it is telling you that companies experienced larger than usual labor cost increases over the last year, 4 to 5% wage growth, and they are still passing that on to higher prices.
Tell me, are you a believer in the evangelist movement that AI is going to deliver such phenomenal productivity gains as we saw during the Greenspan era, which was referred to as the new paradigm? Do you believe in this productivity nirvana that's being proposed to us? Maybe it's real, maybe it will come in time. Your take?
Yeah, I don't have a strong opinion on it yet, but if we do get these, big productivity gains from AI, it probably would really be over the longer medium term. I don't think that's a story for this year. We have had very strong measured productivity growth in the last year, very strong activity. But I think that's also just kind of making up for this bumpiness that we've experienced in a lot of the macro data the last 4 years.
Veronica, you've had a really bold call, and I've really been struck by how much you and Andrew Hollenhorst have really doubled down on this idea that this is a hotter than expected inflationary kind of environment that's going to require a much longer period of time, that the Fed has to hold rates where they are. It's going to lead to a hard landing. How much have you pushed back your timeline for how long the Fed's going to have to hold rates high?
Yeah, I mean, it does seem like the Fed is pretty set on cutting rates this year. Our base case is that we'll see that first cut in June. And I think there's a number of ways that even with stronger inflation data, they can get there. On a year-on-year basis, core PCE probably does look a lot better by the time of the June meeting, even if the monthly prints, stay a bit stronger than comfortable. So I do think they are cutting. But yeah, we've been, fairly firmly in the not soft landing camp. I do think you need to see a broader slowdown to really actually get 2% inflation.
So in other words, have you pushed back your expectation for when the Fed's going to cut, or does that sort of matter less than just sort of the cumulative effect of rates where they are, as they have been over the past couple of years?
Yeah, we haven't really pushed back that expectation at all. I mean, I know markets a month ago were pricing, a cut as soon as March. We've always been much more middle of the year. We still expect that cut coming in June. The question is that, 6 months, period until we get there, less than 6 months at this point, is that going to keep financial conditions tight enough to actually slow things down? It may not. If it doesn't, though, I expect you're still seeing some uncomfortably high inflation data.
Veronica Clark of Citigroup, thank you so much for being with us. Let's get an update on stories elsewhere this morning. Here with your Bloomberg Brief is Yahaira Hakis. Yahaira.
Hi, Lisa. Colorado is the second state suing to block Kroger's $25 billion acquisition of Albertsons. State Attorney General Phil Weiser is seeking a preliminary injunction that would prevent the deal from closing. He says the merger would leave some Colorado communities with less access to groceries. The move comes just a month after Washington filed a lawsuit over the deal. The FTC has been reviewing the proposed takeover for over a year. NVIDIA's scorching rally continues, with the chip maker surpassing Alphabet's market value. It comes just one day after the company overtook Amazon's market cap. The chip giant is up 49% this year, with the company now worth $1.83 trillion, making it the world's fourth most valuable company after Microsoft, Apple, and Saudi Aramco. SpaceX is officially looking to move its location from Delaware to Texas. Yesterday's filing would make it the latest Elon Musk venture to ditch Delaware. Neuralink was reincorporated in Nevada earlier this month. Musk's criticism of the states comes after a judge struck down his $56 billion pay package for his role as Tesla CEO. Musk is threatening to ask shareholders to incorporate Tesla in Texas as well. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. I got to say, Annmarie, he was saying that he was going to do it. Everyone said, yeah, of course you're going to say that, but everybody incorporates in Delaware. Is this sort of the beginning?
And then he did it.
Yeah, exactly.
Yeah. But he did it with SpaceX. The problem is, can he do it with Tesla, given it's a publicly traded company? But he's encouraging more. And he's, calling Governor Abbott and saying, we're all going to be moving to Texas.
Let's see how much this is sort of lip service versus actual call to action. Up next, investors parsing through disappointing retail sales and what it will mean for the Federal Reserve. Rob Waldner of Invesco joining us next. You're watching Bloomberg. This is Bloomberg Surveillance. Jonathan Ferro, Lisa Abramowicz, Annmarie Hordern. Annmarie Hordern is here. Menace Cranny is here. Jonathan Ferro is not, but he will be back next week. We are parsing through retail sales data as it comes in much lower than expected. Here's the latest. January retail sales coming in down 0.8%. Estimates were calling for a decrease of 0.2%. Futures rising, bond yields falling on the news. I guess good news is good news, bad news is good news. Everything's good news. S&P futures up 0.2%. The euro gaining versus the dollar just a bit more, 107.66. You get a bit of ongoing strength in treasuries. Yields lower, down now almost 6 basis points in the 10-year, 4.1968%, rounded to the nearest fourth. But what I'm looking at right now is just how this really translates into a longer term view of a market that was really on the brink of overheating when we got CPI data, then just sort of dashed. And now a question of who do you trust when it comes to the economic data providers? Rob Waldner, Chief Fixed Income Strategist and Head of Macro Research at Invesco, joining us now. Rob, what do you make of this data that we just got?
Hi, Lisa. Well, I think if you add this data that we got today, which is the retail sales, which are disappointing, some of the regional industrial surveys are a bit better, and then you add that to the CPI data that we got early this week, we're just getting a lot of noisy data today, probably impacted by seasonal somewhat, but I think it's all fits within this bigger context where we think the U.S. economy continues to move forward with decent growth. And we have seen the highs in inflation. We're in a disinflationary environment, but as the CPI data pointed out, as we get close, as CPI continues to come down, disinflation continues, the last few bits of disinflation will probably be slower and bumpier than we saw earlier throughout much of last year.
I'm struck by which data point's more important, the initial jobless claims or retail sales. We were talking to Veronica Clark over at Citigroup, and she said, honestly, it's the jobless claims. It's the fact that we still see that health in the labor market, and as long as that's the case, you are going to have a risk of inflation having a much bumpier path down to 2%, to use your parlance. So at what point do you start gaming out a June, a July, a September rate cut as the first from a Federal Reserve that seems to be pretty patient?
Well, I think I would agree that the labor market here is very key to look at. Retail sales, there's a lot of seasonality this month. Credit card spending still seems to be okay. So I think looking at the labor market is key here. We do see signs of labor hoarding. So that has kept, I think, income stronger for people than typically we've seen at this part of the year. So I would look for that labor market for jobless claims. But with the kind of level of growth that we have, and with if this disinflation continues that we think, and of course the CPI data this week added some uncertainty there, but we think the trend is still towards disinflation. The Fed will probably be cutting in May or June.
Good morning to you, Rob. May or June? Well, that's a little bit ahead of where the market managed to push that rate expectation to just the other day. They pushed it all the way into July. Given the landscape that you're looking at the moment, delinquencies are not high. We've just had the CEO of Valley Bank in here. He's talking about measured delinquencies, not that worried about his commercial real estate exposure, etc. You still quite like credit. Just lay that out, because those spreads are tight.
There is a basic conundrum here, right, which is that the macro backdrop is very positive. So steady growth, disinflation, Fed moving towards cuts, very good macro backdrop for all markets, which is why you see credit spreads are tight, equities are doing well, and the technicals in credit are very strong. There's tremendous demand for credit in our view. But you point out valuations are very tight. We're 10 basis points off the GFC tights for investment-grade credit spreads. But I think the thing that we need to remember is what matters to end investors is the all-in yield. And you can get something close to 535 or so in investment grade credit today. Over any longer term period, I think that generally looks quite attractive.
That actually looks quite attractive to me. If I'm sitting in a CD and I go and get 535 on an investment grade credit note, then when it comes to the $6 trillion that's parked in money market funds, the migration of that money will be much debated long after I'm gone back to Bloomberg Brief and off surveillance. But that flow of money, do you think it goes more to equity than it does to credit, or vice versa, given that kind of yield that's on offer there at the moment?
Well, you point out that we have the $6 trillion out there that when the Fed starts to cut, we'll start to realize, the rate that they're getting paid in those money markets will come down, and that money will flow out first to fixed income, and eventually to equities. But, first to fixed income, and I think high quality credit, that's one of the reasons why it's so well supported here, is that if you can lock in for a longer period of time high quality credit at better than you get in your money market, now is a good time to do that.
Okay, so if the flow goes to credit first of all, or into credit, as you say, and then equities, it's not going to all flow in all at once. It took a considerable period of time for incidences to arise to put that money into money market funds. One was yield, but two was also idiosyncratic risk in regional banking. So what portion will cash play as a defense mechanism for the rest of 2024? Because we've got some hot geopolitics. We've got an election coming up.
Yeah, we need to watch carefully, because you pointed out the amount that's in money market funds, but actually it's still been growing, right? So even now, with the Fed sort of said they're done expecting a rate cut, it has still been growing, the balance in money market funds. So it's not that there's been massive flow out yet. So the question is, when does that start in any substantive way? And I think that's probably when the Fed starts to cut rates, because, to your point, cash is a very safe asset in that it's basically government credit, and you're getting a good yield for government credit. The only risk in money market funds is reinvestment risk. And once you start to realize that reinvestment risk, that's when investors will be motivated to look for other alternatives, in our view.
Rob, we just got remarks from Director Lael Brainerd of the White House, prepared remarks she's going to give today. And she talks about disinflation as following that the United States is experiencing a stronger recovery and faster disinflation than our peers. And we wake up, Japan falls into recession, the United Kingdom falls into recession. When will all of this catch up to the United States?
That's a great question, Annmarie, because, the U.S. just seems to be well ahead of most other countries. You pointed out that the UK data today points to technically puts the US in a technical recession. The UK, in a technical recession. European growth has just been very, very tepid, unexciting. Chinese growth has been unexciting, and is now, the Chinese economy is now in outright deflation, both at PPI and CPI level. So in the U.S. here, we've had continued steady, good nominal GDP growth, really outpacing the rest of the world very substantially. So what the end game is there is hard to know, but it certainly involves the Fed getting through this starting into this rate cut cycle in an environment where the dollar, some of the pressure can come out of the dollar can come off, and that's probably supportive for growth elsewhere.
Just 20 seconds, Rob. What's your most contrarian bet right now?
What is the most contrarian bet right now?
Yours, yes.
Well, I think that's a great question. I think that the contrarian bet would be that we get a recession and rates rally very substantially. Then, there certainly is. That was the narrative at the beginning of last year. If that develops again this year, it's not the consensus, but it's certainly a risk.
That's really interesting, Rob. Thank you so much for being with us. Always wonderful to get your thoughts. Rob Waldner there of Invesco. Coming up tomorrow, Sarah Hunt of Alpine Saxon Woods, Greg Valliere of AGF Investments, JP Morgan's Kelsey Barrow, and Steve Rasciuto of Mizuho. Menace, thank you so much for being with us. You'll be joining us again tomorrow.
Day 2.
Exactly. And we'll be plowing forward with you, Mish Sentiment Survey. Have you gotten the call yet, Annmarie?
I have not yet, not gotten the call. I also want to be on the other end of those.
Yeah, you think that would you also do what John does, which is basically come up with really kind of skewed projections
and then see if it shows up, see how much of an impact it made in the survey.
Do you think he just saber rattles?
Yeah, I think that basically you just look at gasoline prices and then you plot out your feelings and then it works through.
Yep.
That's up next. This is Bloomberg Surveillance.